Please like, share, and subscribe. Wishing you happiness and good luck every day.
Today, we're diving into a book that does way more than just offer a few new strategies. It basically wages an all-out war on the core ideas that have run Wall Street for almost 100 years. Martin Whitman and Fernando Diz's Modern Security Analysis, well, it's not an update to the old playbook. It's a full-on declaration that the entire playbook is just flat-out broken.
And that really gets to the core question of this book, doesn't it? What if the whole foundation of modern finance, everything from what they teach at Harvard Business School to what they do on the trading floors, what if it's all built on some seriously flawed ideas? That's a huge claim. So let's get into it.
So here's how we're going to break this down. First, we'll look at the conventional wisdom, the stuff that shapes investing today. Then, we're going to tear down 3 of its biggest myths, one by one. And finally, once we've cleared the rubble, we'll build up the new, much stronger framework that Whitman and Diz propose.
Okay, so to really get what this book is doing, how revolutionary it is, we first have to understand the old rules they're trying to break. So let's start with the big ideas that pretty much everyone on Wall Street is taught from day one.
According to the authors, this right here is the original sin of modern finance. Just about every major investment theory you can think of, from the classics to the super complex academic models, they're all obsessed with the same thing, trying to guess what a stock's price is going to do tomorrow, next week, or next quarter. And that, they argue, that relentless focus on the short term is where everything starts to go wrong.
On one hand, you've got the titans of value investing, Graham and Dodd. Their whole system is about digging into earnings and dividends to find a stock that looks cheap right now. On the other hand, you have modern capital theory. This is the academic world's take, which is all about efficient markets and managing risk by diversifying. But here's the kicker, the author's main point. These two supposed rivals actually share the same fatal flaw. They are both designed to do the exact same thing, try to explain and predict short-term stock prices.
And who are all these theories built for? They're for the OPMI, the outside passive minority investor. That's most of us, right? We buy some shares of a company, but we have absolutely no control over it. We're just passengers. And the book's truly radical idea is that building an entire financial system around the very limited viewpoint of the OPMI is a huge, fundamental mistake.
All right, let's start taking apart these myths. The first one is this idea that's so deeply ingrained in us that the quarterly earnings report is the most important thing in the world. But is it really the whole picture?
So the myth, to put it simply, is that a company's value is all about its profits. Wall Street absolutely loves this idea, right? Because it's clean, you can put it in a spreadsheet, and it makes sense. The authors call this the primacy of the income account, the idea that the income statement tells you everything you need to know.
But here's the big twist. This question really gets to the heart of their argument. What if that laser focus on quarterly profits is like staring so hard at one single brick that you completely miss the design of the entire building? What if the real, massive value is being created somewhere else entirely?
And this shows the two different worlds perfectly. The usual going concern view sees a company as a machine that makes products and spits out profits. Simple. But the authors introduce the resource conversion view. In this world, wealth isn't just earned, it's unlocked. We're talking about the incredible value created when a company sells off a division or when an activist investor forces a huge restructuring. This is where the real control players operate, and you'd never see it if all you do is look at earnings per share every 3 months.
So if the flashy earnings report isn't the foundation of a company, what is? Well, for Whitman and Diz, the answer is simple. It's creditworthiness. Think of earnings like the paint on a house. It might look nice, but it tells you nothing about the foundation. Creditworthiness is the foundation. A creditworthy company has a fortress-like balance sheet. It can get money easily when it needs to, and it has a real economic engine that's way more stable than the jumpy numbers on an income statement. That is the true bedrock of safety.
Okay, on to the next myth. This one is so deeply baked into how we think about finance that it almost feels wrong to question it. It's the idea that the price you see blinking on your screen is what a company is actually worth.
The myth is simple, and honestly, it's pretty tempting to believe. The stock market, with all its buyers and sellers, feels like the ultimate judge, and the ticker price is its final verdict. Modern capital theory especially treats this like it's a scientific law, not just an idea.
But the book argues we're getting two totally different things confused here. On the left, you have the non-control price. That's the price for us, the OPMIs. It's the price for a piece of paper that gives you zero say in how the company is run. It's driven by fear, greed, headlines, you name it. On the right, you have control value. This is the price an expert would pay to buy the entire business, giving them the power to make decisions, sell assets, and do all those valuable resource conversions. One is the price of a stock, the other is the price of the business. And they are not the same thing, not even close.
So this totally wrong idea about price leads us to a totally wrong idea about risk. The entire financial world is obsessed with market risk. You know, the daily up and down roller coaster of a stock's price. But the authors say that's just noise. What really matters to an investor is investment risk, the real danger that you will permanently lose the money you put in. A fantastic company can have a wild stock price and be perfectly safe, while a junk company can have a stable price right up until the day it goes to zero. Avoiding that permanent loss, that's the only game worth playing.
All right, let's knock down our third and final myth. This one is a sacred cow, something we're all told is the gospel of personal finance. The idea that owning more stocks automatically makes you safer.
I mean, you hear this everywhere, right? Diversification is the only free lunch in investing. The logic seems to make sense. If you spread your money across hundreds of stocks, you're protected if one of them goes bust. It's the core risk management tool of modern capital theory, a foolproof defense. Or is it?
But Whitman and Diz just come out swinging with this quote. I mean, it says it all. They argue that for a serious investor, diversification isn't a strategy at all. It's you admitting you don't really have one. It's a stand-in for doing the hard work of actually understanding what you own, who's in control, and what it's really worth.
Now let's be super clear. They are not telling a beginner to put all their money on one stock. For someone who doesn't have the time or the expertise, what they call a know-nothing investor, then yeah, broad diversification is the only way to go. But for a serious, knowledgeable analyst, a know-something investor, concentration in your absolute best, most researched ideas is how you get great results. Spreading yourself too thin, diversifying, just guarantees that your best ideas get dragged down by all your mediocre ones.
So we've smashed the old rickety structure of conventional wisdom. Now what? What do we build in its place? This brings us to the book's really powerful and common sense philosophy, a framework they call safe and cheap.
And it's a super clear 4-step process. Step 1, be safe. That means you only start looking at those highly creditworthy companies we talked about, the ones that are built to resist that true investment risk. Step 2, buy cheap. And this doesn't just mean a low PE ratio. It means buying at a huge discount to the company's net asset value, its NAV, basically what all its stuff is worth. You're trying to buy $1 for 50 cents. Step 3, analyze the management in a whole new way. Are they just good at running the business, or are they also smart investors who know how to unlock that hidden value? And finally, step 4, understand control. Who's really calling the shots? Is there an activist or a family in charge who has the power to make changes that help everybody?
And the payoff for doing all this hard work is huge. First, you build portfolios that are designed from the ground up to resist permanent loss. Because you know your companies inside and out, you have total confidence in them, which lets you just ignore the crazy mood swings of the market. And maybe most important, you often get multiple ways to win. Not just by selling your stock to someone else, but through a buyout, a merger, or one of those other big resource conversion events.
And this, right here, is the killer final move. The authors pull out the original definition of investing from the masters themselves, Graham and Dodd. They said an investment has to have thorough analysis, it has to promise safety, and it has to offer a decent return. Anything else is just speculation. The whole point of this book is that their safe and cheap approach is the true modern version of this timeless rule, while a lot of what passes for investing on Wall Street today is nothing but pure speculation.
So that brings the final question back to you. After going through all this, after rethinking these foundations, prioritizing creditworthiness over earnings, control value over market price, and deep knowledge over diversification, it kind of makes you stop and think, right? Based on these first principles, is what you're doing in the markets truly investing, or is it something else entirely? That's a question definitely worth thinking about.
All right, let's get right into it. We're going to talk about what might just be the single most important and honestly the most misunderstood idea in all of finance. We're talking about investing versus speculating. And believe me, getting this wrong isn't just a simple mistake. It can be absolutely devastating to your financial health.
So here's the game plan. We'll kick things off by looking at just how costly it is when people get this stuff confused. Then we're going to arm you with a rock-solid definition for safety, bust a few common myths you've probably heard, and then build a framework so you can really start thinking like a true investor.
So why are we making such a big deal about this? Well, Because failing to see the difference between investing and speculating isn't just some academic debate. History is littered with the wreckage caused by this one simple point of confusion. It's led to some of the biggest financial disasters we've ever seen. I mean, just look at this timeline. It's like a greatest hits of financial catastrophes, right? From the Great Crash of 1929 all the way to the global financial crisis in 2009. There is one common thread, one consistent, fatal flaw that ties every single one of these meltdowns together. So what is it? What's the big secret mistake that connects all of them? You might be thinking it's some super complex derivative or a high-frequency trading algorithm that went haywire. But the truth? It's way, way simpler. It all comes down to a fundamental misunderstanding of one little word: investing. So how do we fix this? That's what this next part is all about. We're going to go back to the source, to the godfathers of value investing themselves, Benjamin Graham and David Dodd. They gave us a timeless, laser-focused definition that's going to be our benchmark for everything else we talk about. Okay, let's really let this sink in. An investing operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. And here's the kicker. Operations not meeting these requirements are speculative. That's it. It's not a suggestion, it's a bright line. If what you're doing doesn't check all of those boxes, you're not investing. You're speculating. End of story.
So this powerful definition really gives us three clear pillars, or you can think of them as tests. To even be called an investment, an operation has got to pass all three. First, you've done your homework, real analysis. Second, it has to protect your initial capital from serious loss. And third, it needs to offer a satisfactory return. Notice it doesn't say extraordinary or gonna make you rich overnight, just adequate. If you miss even one of these, you've officially wandered into speculation territory.
All right, now that we've got our framework, let's have some fun with it. We're going to take this three-part test and use it to just completely tear down some of the most common and, frankly, dangerous myths you hear on Wall Street. Let's start with a big one. Myth number one, the idea that some things, like government bonds, are just automatically safe investments by their very nature. I mean, we hear it all the time, but let's see if that holds up to our new definition. What do you think? You know, the common wisdom is, yeah, of course, it's a treasury bond. It's the safest thing on the planet. But a real analyst, using our framework, would hit the brakes and say, not so fast. Why? Because the price you pay for that bond is an absolutely critical piece of the puzzle. It directly affects the thorough analysis and satisfactory return pillars. And here's a perfect real-world example. Imagine buying a 10-year treasury back in 2012 that paid you a measly 2%. Your potential gain was tiny. But if interest rates in the wider economy went up, the value of your low-paying bond would drop like a rock. Nobody would want your 2% bond when they could get a new one paying 4%. So it failed the satisfactory return test and even the safety of principal test. It was a speculation on interest rates, not an investment. Okay, on to myth number two. This is the one where people say, hey, I paid cash for this stock and I'm holding it for the long term, so therefore I am an investor. Sounds reasonable, but is it actually true? Nope, not at all. The time you plan to hold something is totally irrelevant. It doesn't matter. In fact, you could do a very short-term trade using borrowed money that is an investment. Think about a riskless arbitrage, where you basically lock in a guaranteed small profit. That passes the test. It has safety and a satisfactory return. See? It's all about the nature and logic of the deal, not how long you're in it. And that brings us to our final myth, the idea that if you're buying something just for the income it kicks off, the dividends or interest, then you're automatically playing it safe. You're investing. This is a super popular strategy, but does it really pass our test? Well, here's the trap. Especially when interest rates are really low, a desperate hunt for income can make you blind to risk. It can push you into buying junk just because it has a high yield. But you always have to look at the total return. That's the income you get, plus or minus whatever happens to the price of the asset itself. If the risk of the price falling wipes out your income, you are speculating, plain and simple. Okay, so we've torn down a lot of bad ideas. Now it's time to build up a good one. This next section is all about giving you a practical, repeatable framework you can use to analyze risk and make sure you're always staying on the right side of that line between investing and speculating. And I'm going to see this again because it is that important. Investing is not about picking winners or finding a good story. It's a process. It's an operation focused squarely on judging and avoiding risk. And the price you pay isn't just a detail. It is an absolutely essential, non-negotiable part of that process. So here it is. This is your 3-step checklist. This is what thorough analysis actually looks like. Step 1, the quality of the issuer. Is the business behind this stock or bond actually healthy? Step 2, the terms of the issue. What are you actually buying? What are your rights? And step 3, the final boss, the price. Does the price you're being asked to pay give you a margin of safety, a cushion in case things don't go perfectly?
Now, let's make this really personal. I want to introduce you to a term you may not have heard before, OPMI. It's an acronym, and chances are it describes you, me, and pretty much every other regular person in the market. So what is an OPMI? It stands for Outside Passive Minority Investor. And you are one if you have zero control over the companies you own shares in, you only get to see the same public information as everyone else, and you're basically the exact person the securities laws were written to protect. Does that sound like you? Yeah, me too. The difference here is night and day. You've got the OPMI on one side who's on the outside looking in. And on the other, you have an activist investor who can actually get in there, influence the business, and see stuff that we don't. And this is exactly why having a disciplined framework like the one we've been talking about is so critical. It's your shield. It's your best defense when you can't control the game yourself.
Whew, we have covered a ton of ground. So let's boil it all down. Let's get to the single most important, distilled truth that I want you to walk away with today. If you remember literally one thing from all this, make it this. No stock, no bond, no asset is an investment just because of what it is. The investment part isn't in the thing, it's in the operation. It's in your analysis, it's in your discipline, it's never about what you buy. It is always about how and at what price you buy it. And so that brings us to the final and maybe the most important question. It's time to turn the lens on yourself. Take a good, hard, honest look at your own portfolio, at the decisions you've made, and ask yourself, based on everything we've talked about, have you really been operating as an investor, or have you been speculating? Hey, welcome. Today, we're going to dig into something that's at the very heart of how we think about business success. We're going to challenge and maybe even tear apart one of the most common metrics you hear about, and I promise, by the end of this, you'll see things through a completely new lens. So let me ask you a question. If you had to pick just one number, the number one metric to judge how well a company is doing, what would you pick? For most people, the answer is pretty automatic. It's all about the quarterly earnings, right? Specifically, that magic number, earnings per share, or EPS. It's the headline everyone waits for. But what if it's not? What if that obsessive quarterly focus on profits is actually a trap? What if it's blinding us to how the world's greatest companies really build lasting generational wealth? What if there's a much bigger, much more interesting game being played that EPS doesn't even begin to capture? Okay, so here's our game plan. First, we're going to bust the earnings per share myth. Then, we'll unpack the conventional view that it comes from. After that, we'll look beyond just the day-to-day grind to see a more powerful framework called resource conversion. We'll even look at how the giants of industry use it. And finally, we'll see how this brand new lens can totally transform how you analyze any business. You see, this obsession with quarterly earnings isn't just some casual habit. It's this deeply ingrained way of thinking. And the problem is, it's incredibly myopic. It's like trying to understand a whole landscape by looking at it through a keyhole. You get a tiny glimpse of what's happening right now, this quarter, but you completely miss the bigger picture, the strategy, the opportunities, the whole horizon. Now, this traditional mindset actually has a formal name in finance. It's called the pure going concern view. And it's not new. Its roots go all the way back to academic theory from the 1950s. And believe me, it has shaped how generations of analysts look at companies. So what does this pure going concern view actually mean? Well, essentially, it sees a business as a simple, steady machine. A machine that just keeps doing what it's always done, managed the same way it's always been managed, to produce a nice, predictable stream of earnings. Think of it like a dependable old factory, just humming along, churning out the same widgets, and spitting out profits in a constant, unchanging loop. The thing is, this framework has 3 huge flaws just baked right into its DNA. First, what's called the primacy of the income account. This means an almost total focus on flows, like earnings, and not much else. Second, the primacy of short-termism, where the goal becomes predicting the stock price for the next quarter, not understanding the company's real value for the next decade. And third, the primacy of top-down analysis, which means analysts spend more time worrying about GDP than about the specific, game-changing moves the company is making. And this way of thinking leads to a really narrow judgment of leadership. If the company is just a machine, then management's only job is to be a good operator. Their whole appraisal is based on whether they can squeeze out a bit more margin, boost sales by 1%, or cut some costs. They're just supposed to keep the machine running smoothly. But is that really all that great leaders do?
Yeah, absolutely not. The truth is, the most successful companies on Earth create wealth in ways that go far, far beyond just the day-to-day operational grind. They are playing a much bigger, more strategic game.
So, the real question is, how do these truly superior management teams do it? How do they create that incredible long-term value? Well, they focus on what you could call long-term opportunism. They aren't just operators. They're active wealth creators, constantly scanning the horizon for those big strategic moves that can fundamentally transform the business. And that old going concern view, it completely misses these massive wealth-creating activities. Things like raising money on incredibly good terms, giving them a war chest for growth, or making smart, opportunistic acquisitions of other companies, or even launching entirely new businesses from scratch when the moment is right. And finally, cleverly exploiting when the market gets things wrong through things like stock buybacks or spinning off parts of the company. These are not day-to-day tweaks. These are game-changing decisions. And all of this brings us to a much more powerful and, frankly, more realistic way to look at a business. It's called the resource conversion framework. And this isn't about throwing out the old ideas completely, but about building on them to get a picture that actually matches reality. The resource conversion view sees a business as a hybrid. Of course, it has its day-to-day operations, the going concern part. But, and this is crucial, it also acts as an investment vehicle. Management's job isn't just to run the factory. It's to actively convert the company's resources, its cash, its assets, its people, into new, more valuable forms. They are constantly reshaping the business to create more wealth.
And this chart just lays out the difference perfectly. The old going concern view is obsessed with short-term flows, like earnings. The resource conversion view shifts the focus to the company's assets, its net asset value, and what management can do with them over the long haul. And that means the way we judge management has to change too. They're not just operators. They have to be judged as operators, as shrewd investors, and as savvy financiers. It's a three-dimensional job.
All right, so you might be thinking, okay, this is a cool theory, but is this really how things work in the real world? Well, let's stop talking theory and look at the cold hard data from some of the biggest companies out there. Let's ask ourselves, do the titans of the Dow Jones Industrial Average, the blue chip stocks, do they really act like those simple, steady, going concerns? Or are they constantly playing this resource conversion game we've been talking about? Just take a look at this. This table shows the number of mergers and acquisitions, a key resource conversion activity, for some of the biggest Dow Jones companies over just 5 years. The numbers are just wild. You've got Cisco and IBM, both with 44 deals. Exxon with 36, Microsoft 31. These are not companies just sitting on their hands and running their existing business. No way. They are constantly buying, selling, and transforming themselves. And then you've got Bank of America. Get this, 64 mergers and acquisitions in 5 years. 64. That is more than one deal every single month. This is the absolute opposite of a sleepy going concern company. This is the definition of a business that is actively converting its resources to create wealth. So after all that, what's the big takeaway? What does this actually mean for you when you're looking at a business? Well, adopting this resource conversion lens fundamentally changes where you put your focus. It changes everything. First off, you stop giving all the power to a single number like quarterly EPS. Instead, you start digging into the numbers to figure out what they actually mean about the health and potential of the business. Suddenly, the company's resources, like having a fortress-like balance sheet, become absolutely critical. And most importantly, you start looking at management through that three-dimensional lens. Are they good operators? Yes, but are they also smart investors and skilled financiers? And if you need just one line to sum all of this up, this quote from the source material absolutely nails it. One good deal may create more wealth than 10 years of brilliant operations. Think about that. A single brilliant acquisition or a perfectly timed spinoff can create more value literally overnight than a decade of just grinding it out. So, the next time you're looking at a company, I want you to ask yourself this question. Are you just seeing the factory floor, the day-to-day churn of operations? Or are you seeing the bigger picture, the entire dynamic resource-converting engine of long-term wealth creation? Because seeing that engine, well, that changes everything. Thanks for tuning in.
Welcome to The Explainer. Today, we are diving deep into a fundamental question in finance. When you look at a company's stock price, are you seeing its true value? Or is that just scratching the surface? We're going to unpack two very different ways of looking at the market, and it might just change how you think about investing.
You know, it really all boils down to the questions you're trying to answer. Are you asking, what is this business fundamentally worth over the long haul? Or are you asking, what's the stock price going to be tomorrow, or even today? These two questions, as you can see, lead to two completely separate universes in finance.
So here's our game plan for today. We're going to lay out these two competing views, then we'll dig into the core assumptions of mainstream financial theory. After that, we'll see if those assumptions hold up in the real world, using the heated debate over stock options as a perfect test case. And finally, we'll wrap up by exploring what it means to invest with a more fundamental mindset.
All right, let's get right into it. To really get a handle on the mainstream view, we have to start with the main character of that story, the everyday investor. And that character has a name, the OPMI. It stands for Outside Passive Minority Investor. Now, that's just a fancy way of saying, well, most of us. You buy some shares in a company, you own a tiny little slice, but you don't actually have any say in how the business is run. And here is the absolutely crucial part. Almost the entire body of modern finance is built from the perspective of this one type of investor.
And this is where a really powerful analogy comes into play. The source material puts it this way. Looking at finance only through the eyes of an OPMI is like trying to understand the entire ocean by just looking at the plankton floating on the surface. Sure, you're seeing something, but you're missing pretty much everything that actually drives the ecosystem.
Exactly. The plankton, that's us, the OPMIs, we just get pushed around by the currents. But down below, you've got the real players, the ones making the waves. The sharks, the whales. In the corporate world, these are the management teams, the big creditors, the people with controlling stakes. They don't just follow the currents, they make them.
Okay, so if the whole mainstream theory is built on this one narrow viewpoint, what's holding it all together? Well, it turns out it all rests on two massive assumptions. Assumptions that, from a fundamental point of view, are more like myths.
Assumption number one is this idea of substantive consolidation. It's the belief that a company and its shareholders are, for all intents and purposes, the same thing. Their goals are identical. What's good for the stock is good for the company, and what's good for the company is good for the stock. A perfect, happy alignment.
And that belief leads right into assumption number two, structural subordination. This is the big one. It's the idea that a company's whole purpose for existence, its entire reason for being, is to maximize value for its stockholders. Every other consideration, every other relationship takes a back seat to that one primary mission.
But here's the big what if that fundamental finance throws into the mix. What if this perfect world where everyone's interests are aligned isn't the rule? What if it's the exception? Because if that's true, then the whole foundation of mainstream finance starts to look really, really shaky.
So let's put that first myth, substantive consolidation, to the test. And the best way to do that is to compare how the textbooks say big corporate decisions should be made with how they're actually made in the real world. According to the theory, it's all very clean. A company wants to build a new factory. It should calculate the potential return and then ask one simple question. Is this return better than what our shareholders could get on their own in the open market for a similar amount of risk? If the answer is no, theory says you shouldn't build the factory. You should just give the cash back to the shareholders and let them invest it themselves. But let's be real. That is not the conversation happening in most boardrooms. Managers are asking totally different, practical, company-first questions. They're asking, do we even know how to do this? Can we get a good loan? How does this decision affect our own control over the company? What's the worst that can happen to us? You'll notice the stockholders' theoretical opportunity cost is nowhere on that list. And this difference in perspective just explodes into view when you look at one specific topic, the surprisingly intense debate over how to account for executive stock options. It is the perfect case study.
Now, the mainstream argument, summed up perfectly here by Warren Buffett, seems like pure common sense. Options are given to executives as part of their pay. Pay is compensation. Compensation is a business expense. And expenses, of course, reduce a company's profits. Case closed, right?
Well, not so fast. From a fundamental finance perspective, this whole line of thinking is a huge category mistake. See, the company has problems, and its creditors have problems. And those problems are all about cash. Does the business have enough cash to pay its bills? Cash expenses are a company problem. But stock options cost the company zero cash. They are a stockholder problem because they water down or dilute the value of the shares that people already own.
Okay, so let's walk through the math on this, because this is where it really clicks. Let's say we have a company with 1 million shares and it makes $1 million in profit. Simple enough, the earnings per share, or EPS, is $1. Now, some executives exercise their options, creating 100,000 new shares. The company gets a little cash for that, which it uses to buy back 25,000 shares from the market. But do the math. 100,000 minus 25,000 means there's still a net increase of 75,000 shares. The company's profit is still $1 million, but now you have to divide that profit by more shares, and look what happens. The EPS for the original owners drops from $1 all the way down to 93 cents. That dilution, that is the real cost. It's not a line item on the income statement, it's a direct hit to the value of your ownership.
Here's another way to think about it. Saying the cost of the option is its market value to the executive is kind of nuts. It's like saying a clothing store's cost for a sweater is the full $100 retail price, even though they only paid the factory $35 for it. The value a person receives and the cost the company incurs are two completely different numbers. And this whole options debate perfectly sets up our attack on the second big myth, the idea that a company exists solely for its shareholders. I mean, think about it. If the company and its owners can't even agree on something as basic as what counts as a cost, how truly aligned can their interests be?
The truth is, the corporate world is a tangled web of conflicts. The company's long-term health can be at odds with what management wants for its bonuses. Management's goals can conflict with what a powerful, controlling shareholder wants. And most importantly for this discussion, management's interests are very often not the same as the interests of us, the outside passive investors.
And you don't have to look far for proof. Just look at all the corporate defense tactics out there, things people call shark repellents. You've got poison pills designed to make a takeover crazy expensive, or staggered boards that make it impossible to fire all the directors at once. These rules serve one main purpose: to protect the current management team from the very people who own the company, the shareholders. Now, if their interests were truly the same, why would managers need to build a fortress to keep the owners out?
So we've picked apart the mainstream view and its assumptions. What's the big takeaway? How should this fundamental finance perspective change the way we actually invest?
It all comes back to that iceberg. The OPMI view, the daily stock price, that's just the 10% you can see above the water. To really, truly understand a business and its long-term value, you've got to look at the other 90%. You have to analyze the motivations of the management team, the power held by the company's lenders, and the agenda of any big controlling shareholders. That's where the real story is.
And that leaves us with one final, crucial question to ask ourselves. The next time you analyze an investment, are you just watching the ripples on the surface, or are you trying to understand the deep, powerful currents running underneath? Are you seeing the whole ocean, or just the plankton? Thinking about that just might change everything.
All right, let's jump right in. Today, we're going to challenge pretty much everything you thought you knew about what gives a stock or a bond its value. We're going to look way beyond that flashing ticker price to uncover the hidden mechanics, the stuff that truly drives an investment's worth. So, for decades, this right here, this was the bedrock of security analysis. Back in 1938, a guy named John Burr Williams gave us this classic definition. Value is simply the future cash you're going to get. Dividends, coupons, principal. It's a really straightforward idea that totally shaped how generations of investors thought about value. But what if that beautiful simplicity misses the bigger, messier, and honestly, a much more interesting picture? What if dividends and coupons are just one tiny piece of a much, much larger puzzle?
Okay, so let's explore a more modern and, I think, a more powerful idea. The source material for this whole explainer suggests a pretty radical update. Investment value isn't just about what the company decides to pay you. It's the present worth of all future cash bailouts. Now, a bailout, that's a much broader concept that includes every possible way an investor can get cash out of a security.
So, here's our roadmap. First, we'll nail down what a cash bailout really is. Then we're going to explore the two completely distinct worlds of investing, how they interact with each other, why a security's identity can literally change, and finally, how to unmask those hidden factors that create a gap between price and true value. So, first up, what in the world is a cash bailout? Well, think of it as any way an investor gets their cash out of an investment. And believe me, it goes way, way beyond just sitting around and waiting for a dividend check. Let's unpack these 6 forms. You've got your traditional stuff, of course, contractual payments and dividends. But then it gets really interesting. You can sell your shares, not just to another investor on the stock market, but in a big merger or acquisition. You can use your securities as collateral to borrow money. That's generating cash without selling a thing. If you actually have control of the company, you can extract all sorts of unique benefits. And finally, some securities just come with some really powerful tax advantages. The big idea here, there are a lot of ways for an investor to get paid. And this brings us to a really crucial idea. Not all stock is created equal. I mean, there is a massive, fundamental difference between owning a few shares and owning the entire company. This slide just lays it out so clearly. Control stock and what we call OPMI, that's outside passive minority investor stock. They're basically different commodities. Seriously, they trade in completely different markets, they're bought by different people for totally different reasons, and they're even protected by different sets of laws. A control buyer is looking for strategic value. They want to run the show. An OPMI investor, which is probably most of us, is typically just hoping the stock price goes up.
And you gotta understand, corporate law often helps insiders and management hold onto that control for dear life. They have a whole toolbox of what are called entrenchment devices. You've got staggered boards, poison pills, rules that make it nearly impossible for shareholders to do anything. These are all designed to protect the people in charge, a lot of times at the direct expense of minority investors.
Okay, so now let's look at how these two very separate worlds, the control market and the public market, actually interact. Because they're in this constant dance, arbitraging the price differences between each other over the long term. It's fascinating.
And this slide shows that cycle perfectly. When prices in the public market get really high, what happens? Well, the control holders see a great opportunity to sell shares to the public through IPOs. But on the flip side, when public prices get super low, the smart money in the control market starts buying, taking companies private, often through what's called a leveraged buyout, or LBO. It's this constant flow of capital back and forth between the two worlds.
But, this cycle isn't some perfect, efficient machine. Real-world frictions always get in the way. Public markets can be totally unpredictable, right? Access to credit can just dry up. And as we just talked about, entrenched management can flat out prevent a change of control, even when it makes all the financial sense in the world. Now for another really interesting twist. We love to put securities in neat little boxes. This is debt, that's equity. But the reality is, a security's true nature often just depends on your perspective. It depends where you're sitting. So let's take subordinated debentures. That's basically a type of loan that gets paid back after other, more senior loans. Now, if you're a common stockholder, you're at the bottom of the pile. You look up the capital structure and you see that subordinated debt. To you, it is clearly a loan, a debt that has to be paid back before you ever see a penny. But, and this is the cool part, if you're a senior lender, you're at the top. You look down the capital structure at that exact same subordinated debenture, and what do you see? You see a cushion of capital that protects your loan. From your perspective, it acts a lot like equity. It's the same security, but it lives in two completely different realities. Let's look at a real-world example of this. This is a finance company's layer cake capitalization. You can see all the layers here, from common stock at the very bottom, all the way up to senior debt at the top. Now, I want you to notice that tiny little slice of preferred stock, just $10 million. That tiny $10 million sliver of preferred stock is incredibly powerful. By adding it to their capital base, it massively increases the company's borrowing capacity, allowing them to take on an extra $80 million in senior debt. That is some incredible leverage. And it's exactly why preferred stock exists, even though its dividends aren't tax deductible like the interest on debt is. Here's another really powerful way to think about this stuff. See every single term in a securities contract as either an option, which is a choice or a privilege, or an obligation, which is a duty. So, for example, a feature that lets a company buy back its bonds, that's an option for the company. But a mandatory redemption date, that's an obligation. When you start seeing securities this way, it reveals the true balance of power between the issuer and the person who holds the security. Okay, let's bring this all home. We've seen that value is really about cash bailouts, and that a security's true nature really depends on who holds it. So now, let's look at the final piece of the puzzle, the specific factors that can drive a wedge between a security's market price and its actual true value.
And the key concept here is alienability. It's kind of a fancy word, but all it means is the ease with which a security can be sold or transferred. Anything that messes with that alienability can create a pretty big gap between price and value.
And there are 4 main factors here. First, simple contractual restrictions, like a lockup period after an IPO. Second, you've got securities law restrictions, which might apply to insiders. Third is something called blockage. Basically, if you own a massive block of stock, you can't just dump it all on the market without completely crashing the price. And finally, the most important one of all, control. And these factors, they have a real, tangible financial impact. Restrictions and blockages, for example, they typically result in a big discount to the market price, often somewhere in the range of 15 to 50%. Control, on the other hand, almost always commands a significant premium. So look, if you remember just one thing from all of this, let it be this. A security's market price is not the same thing as its value. It's just a starting point for your analysis. You have to dig deeper. You have to understand who holds it, what rights they have, and how easily they can actually turn that piece of paper into cold, hard cash. Which really leaves us with a final and kind of provocative question, doesn't it? If a security can be debt to one person and equity to another, if its value can be discounted by 50% or command a huge premium, all depending on who happens to own it, how can you ever really, truly trust that simple little number you see flashing on the ticker? Welcome to The Explainer. Today, we're diving into a question that really gets to the heart of how we value companies. Is it all about the earnings they report, or is it about the wealth they actually create? We're about to challenge a belief that's, well, it's practically gospel on Wall Street. So if I asked you, point blank, for the #1 metric of a company's success, what would you say? You'd probably say earnings, right? I mean, that's the number Wall Street lives and dies by. But what if I told you that focusing on earnings is like judging a book by its cover? And, sometimes that cover is flat out lying. All right, let's get right into it. Here's our game plan for today. We're going to start by busting that earnings myth wide open. Then we'll talk about the real goal, wealth creation. We'll look at the 3 main paths companies use to build that wealth, and then figure out why on earth Wall Street is so obsessed with earnings. We'll even have to redefine what earnings really means. And finally, we'll land on a much more powerful concept, earning power. Okay, first up, let's tackle this thing head on. We're going to challenge the biggest, most common metric in all of business, this idea that reported earnings are the be-all and end-all. The source material we're digging into today, it does not pull any punches. It just comes right out and says that for any real fundamental analysis, our obsession with earnings and cash flows is just a myth, pure and simple. Now, that's a bold statement that should probably make you rethink every single headline you see on financial TV. Now, here's where it gets kind of nuanced. The source is quick to point out that this myth is very, very real in one specific playground, the world of day trading. Yeah, in that super fast-paced game, it is all about this quarter's earnings and what everyone thinks next quarter's will be. But, and this is a big but, if you're trying to understand the actual long-term value of a business, that's a completely different sport. So if racking up huge reported earnings isn't the real goal, then what is? This is where we need to make a small, but honestly, a really powerful shift in our thinking. Here it is, the core idea. Once a business is up and running, its #1 job is to create wealth for its owners. Period. Think of reported net income as just one tool in the toolbox. It's like a hammer. It's useful, for sure, but you can't build a whole house with just a hammer. It's just a means to an end, not the end itself. And this slide right here perfectly illustrates that point. Just look at the completely opposite goals of public and private companies. Public companies, right, they're under this intense microscope, so they often do everything they can to pump up their reported earnings. It makes the stock price look good, it helps them raise more money, even if it means paying more in taxes. Private companies, they're playing a totally different game. They often try to minimize their reported earnings to slash their tax bill, which, guess what, puts more actual wealth directly into the owner's pockets. So, if earnings are just one piece of this whole wealth creation puzzle, what are the other pieces? Let's take a look at the different ways companies can build real, lasting value. The source material lays out this really simple 3-part playbook. Path 1, that's the one we all know and talk about, generating earnings and cash flow from your day-to-day operations. But there are 2 other paths, and honestly, they're often way more powerful. Path 2 is making smart moves with your resources. And Path 3 is having great access to capital. Okay, let's unpack those a bit. Resource conversions just sounds like a fancy term for big strategic moves that can completely change the shape of a company. We're talking about major mergers, or a company using bankruptcy to reorganize, spinning off a whole division, or a private equity firm buying the company outright. These are huge wealth-creating events. And then there's access to capital. Think about a company going public with a hot IPO, or getting non-recourse financing. That's a special kind of loan where the lender can only seize the asset they financed, not the whole company if things go south. That is a massive advantage, and it has nothing to do with this quarter's income. Okay, so now that we have this bigger picture, we can finally circle back and really understand why Wall Street is so obsessed with earnings. Why is their spotlight always on this one single number? Well, especially in a booming market, a company's stock price is often just a cocktail of these four ingredients. You've got the earnings they just reported, sure, and you have what analysts think they're going to report next quarter. But just as important, sometimes even more important, are the industry they're in and who is backing them. And this idea of sponsorship is an incredibly powerful force. It's when a company is backed by people who seem to have the Midas touch, investors with a long track record of making a ton of money. Think of those huge private equity firms or legendary entrepreneurs. When they get involved, the market often just assumes success is inevitable, and the stock price jumps to reflect that, no matter what the current earnings look like. It's really just Wall Street betting on the jockey, not just the horse. Let's see this in action. This source gives us this fantastic real-world example. On the screen are two companies, AECom and Broadcom, and their earnings per share over a 5-year stretch. Just take a second to look at those numbers, look at the trends, see if anything jumps out at you. Okay, so here's the kicker. ACEM was the tortoise, just slow, steady, predictable earnings growth year after year. Broadcom was the hare. Its earnings were all over the place. And yet, the market valued that hare at a multiple nearly 4 times higher than the tortoise. Why? It's simple. Broadcom was in the right place at the right time, the sizzling hot wireless industry. The market fell in love with the story, not just the numbers.
All of this brings us to an even deeper, more fundamental problem. We've been throwing this word earnings around this whole time, but what does it actually mean? Turns out it's not nearly as simple as you'd think.
Let's take a little trip back in time to the 1950s for this amazing story from the source material. There was this small company, Benson & Hedges, and they launched a new product, the Parliament cigarette. And it was a massive, instant hit, so you'd think their earnings were just through the roof, right? Well, on paper, yeah, the more cigarettes they sold, the higher their accounting profits climbed. But here's the crazy twist. To make those cigarettes, you have to age tobacco for years. So for every single pack they sold, they had to spend a fortune on inventory that would just sit there for a long, long time. They were literally selling themselves into a cash crunch. Their reported earnings looked fantastic, but in reality, they were running out of money to keep the lights on. It's a perfect example of the disconnect between paper profits and actual financial health. And that story isn't just a one-off fluke. The problem is baked right into the system. The source material points out that there are at least 6 different totally valid ways to define earnings. Is it what the accountants say it is? Or is it the actual increase in the business's value? Or maybe it's the cash it can actually hand out to shareholders, or the money it has to pay back its lenders. With so many different answers, how can we possibly pretend it's one single reliable number? So what's the solution? Where do we go from here? Well, let's put all these pieces together and build a much better, more robust way to think about a company's true potential. The key really is to shift your focus from the rearview mirror to the road ahead. Earnings, that's the rearview mirror. It tells you exactly where you've been. It's a precise, but as we've seen, often misleading number from the past. Earning power, that's the windshield. It's all about the company's fundamental ability to create wealth in the future based on the resources it controls today. So here's your new mantra. This is the big takeaway. Instead of getting fixated on the income statement, look at the balance sheet. A company's true earning power is written in its assets, in its financial muscle, and its strategic position in the market, not just in the accounting numbers from last year. So we'll leave you with this final thought. The next time you're analyzing a business, are you going to get caught up in the short-term noise of reported earnings? Or are you going to dig deeper and look for the real story, the company's fundamental power to create wealth over the long haul? That one little shift in perspective, it's the difference between being a sheep and being a shepherd. Whenever you hear people talk about valuing a company, where does the conversation always seem to go? Right? To earnings. But what if I told you there's another, more foundational metric that just gets overlooked most of the time? Today, we're going to dig into something called net asset value, or NAV, and you'll see why it might just be the unsung hero of security analysis. I mean, it's the fundamental question every single investor asks. What's a company really worth? Is it just a profit it spits out every quarter? Or is it the sum of its parts, the actual tangible stuff it owns? How you answer that? Well, it reveals two totally different philosophies of investing. Exactly. So think of it like this. In the world of finance, earnings are the star quarterback. They get all the headlines, all the glory, and they're what drives the stock price up and down day to day. But net asset value? That's the powerful offensive line. A lot less glamorous for sure, but they're absolutely critical if you want to understand the real strength and potential of the team. So, here's our game plan for today. First, we'll properly introduce this unsung hero, NAV. Then, we'll explore why earnings kind of took over the spotlight in the first place. After that, we're going to zoom out for a much broader perspective, back it up with some pretty surprising data, and then give you a practical toolkit. We'll even redefine what a bargain really is, and wrap it all up with why this matters so much for long-term stability. All right, let's get right into it. Time to meet this unsung hero. What in the world are we talking about when we say net asset value? Well, at its core, it's actually beautifully simple. You just take everything a company owns, all of its assets, and then you subtract everything it owes, all of its liabilities. The number you're left with? That's the net asset value. You can think of it as the accounting value of the company's net worth. Or maybe even better, it's what would be left for shareholders if the business just shut its doors and sold everything off today. Okay, so if NAV is so straightforward and so fundamental, you're probably wondering, why don't we hear about it more often? Well, that brings us to the reigning champion of financial metrics, earnings. And look, this isn't just a hunch, it's practically dogma in the accounting world. This quote from an actual accounting textbook makes it totally clear. For decades, the entire financial community has been trained to see the income statement, that's the report card on profitability, as the single most critical piece of information a company provides.
So why this intense focus on earnings? Well, it really comes down to a specific point of view. The system is designed for what are called strict going concerns, businesses that are just expected to keep operating as usual, day in and day out. And it's seen from the perspective of OPMIs, outside passive minority investors, which, let's be honest, is most of us. For that group, the people influenced by daily stock prices, quarterly earnings are the main event. It's so ingrained that even the fathers of value investing, Graham and Dodd, generally put earnings first in their analysis.
But what if that view is just too narrow? What if a company is so much more than just a machine for generating quarterly profits? This brings us to a really powerful contrarian perspective. Now, this quote directly challenges that conventional wisdom we were just talking about. This is the core idea of our source material. It argues that for almost any kind of analysis, unless you're just trying to predict tomorrow's stock price, the balance sheet, and specifically NAV, is the much more logical place to start. And here's why. Most businesses aren't just operators. They're also investors and financiers. They're constantly involved in what the Source Search calls resource conversion, stuff like mergers and acquisitions, selling off divisions, or doing a major refinancing. So for anyone thinking like a creditor, an activist investor, or even just a very long-term owner, understanding the value of the underlying assets is everything. And earnings alone, they just don't give you that picture. So, the traditional view, the one that was championed by Graham and Dodd in their early studies, was that for most industrial companies, there was no real link between how much a company earned and the value of its assets. A stock's price, they argued, was pretty much entirely dependent on its earning power. But what if that assumption is just flawed? What does the data actually tell us about the relationship between what a company earns and what it's worth on the books? Let's take a look. Okay, let's look at some real data from the Dow Jones Industrial Average back in 2012. You can see a few examples right here. Bank of America had a low PE ratio, and, what do you know, it was also trading at a huge discount to its book value, its NAV. Now go down to IBM and McDonald's. They have much higher PE ratios, and they're also trading at massive premiums to their NAV. You starting to see the pattern here? And boom, this illustrates the point perfectly. When you plot all 30 Dow companies from that period, the connection is just undeniable. This scatter plot shows a really strong positive correlation. As the market is willing to pay more for a company's earnings, a higher PE ratio,
It's also willing to pay a higher premium over its net asset value. They aren't unrelated at all, they move together. The takeaway is pretty clear. Saying earnings matter but NAV doesn't is just a logical contradiction. So now that we've established that NAV is a critical and related metric, how can an investor actually use this insight? Well, let's move on to the NAV Investor's Toolkit and see how this all builds into a practical strategy. The source material lays out a very clear 4-part test. First, is the company rock solid financially? We're talking no excessive debt. Second, can you buy the stock at a significant discount, say 20% or more to its NAV? Third, and this is the dynamic part, does it have the potential to grow its NAV by at least 10% every year? And finally, are there any catalysts coming up, like a potential merger, that could force the market to recognize the true value and close that discount? This framework naturally leads us to redefine what we even mean by a bargain stock. It takes a classic value investing idea, the net-net, and gives it a modern, much more sophisticated upgrade. So first, let's just make sure we understand the original. A net-net, as defined by the great Benjamin Graham, was a true cigar butt investment. It was a company trading for less than the value of its current assets, like cash and inventory, after you subtract all of its liabilities. The logic was you were basically getting the factories, the brand, and the entire business for free. But our source argues for a much more nuanced approach. Instead of just blindly following the accounting label of current assets, this redefined view uses judgment to figure out what's truly liquid. It adds a crucial filter. The company has to be extremely well-financed because a bargain isn't a bargain if it's about to go bankrupt. It also looks beyond the balance sheet to include any hidden liabilities. And it smartly recognizes that even fixed assets, like a factory, can be a source of cash through tax refunds if they're sold at a loss. It's just a much sharper, more robust definition of a bargain. Which brings us to our final and, I think, most important point. This entire approach, it's not just a valuation trick, it's a philosophy for navigating the markets with a lot more confidence. You see, focusing on NAV fundamentally shifts your mindset. You stop worrying about predicting the unpredictable, next quarter's earnings report, or the market's daily mood swings. Instead, you anchor your analysis and your capital to something real, something you can calculate and actually understand, the underlying net worth of the business. I absolutely love this quote from this source, an anchor to windward. It's an old nautical term for a safety anchor you use in a storm, and that is the perfect metaphor. Earnings can be volatile, swinging wildly with the economy, but a strong balance sheet, a large net asset value with very little debt, that provides stability. It's the anchor that holds firm for both the company and for its long-term investors when the market seas get really rough. And that leaves us with a final question to think about. In a world obsessed with the next earnings report and the daily chatter of the market, it's worth asking yourself, what is your portfolio really anchored to? Is it tied to the shifting winds of sentiment or to the solid ground of tangible value? Welcome to The Explainer. We're here to break down the big, complicated topics. And today, we're going to be unlocking some of the biggest secrets of financial health, challenging the stuff you hear all the time about debt, about staying solvent, and what really makes a company stable. So you've probably heard things like this from some pretty big names, and it's enough to give you whiplash, isn't it? I mean, on one hand, we are constantly being told that debt, whether it's ours, a company's, or the country's, is basically a ticking time bomb. But then you see quotes like this and you think, wait a minute, maybe the rules are different for the big players. And that contradiction, it leads to a really huge question. What if the conventional wisdom we have about financial stability, what if the rules we think decide who succeeds and who fails are actually built on a total myth? What if staying afloat is completely different from what we've all been taught? Okay, let's really dive into this. All right, first up, let's just tackle the basic idea of staying in business. The whole concept of solvency, it seems simple, right? Can you pay your bills, yes or no? Well, the official definition is a little more complicated, and the reality is even more surprising. So if you open up a finance textbook, you'll find these 3 pillars of creditworthiness. You've got the balance sheet test, pretty straightforward, do you own more than you owe? Then there's the cash flow test, is enough money coming in the door to pay the bills on time? And finally, the liquidity test. If you suddenly need a bunch of cash, can you actually get it from investors or lenders? Now, the logical assumption, the one we all make, is that a healthy company or government has to pass all 3 of these, no problem. I mean, failing even one sounds like you're on the brink of disaster, right?
A negative balance sheet, no cash coming in, being cut off from borrowing, any one of those sounds totally fatal. But here's the kicker. The reality, the part that very few people seem to realize, is that an entity, whether it's a massive bank, a corporation, or even a government, often only needs to pass one of these tests to survive. Yeah, you heard that right. Just one. Think about what that really means for a second. It just completely flips the script on the traditional view. It means survival is way more flexible than some simple three-point checklist. A company can be, technically insolvent on paper, but still be a perfectly functioning, creditworthy part of the economy. This isn't some tiny loophole. This is literally how the system actually works. And this isn't just a theory. You see it play out in the real world all the time. Just think back to the 2008 financial crisis. Remember that term zombie banks? Their balance sheets were an absolute disaster. They failed test 1, no question. But they could still process your checks and transactions day to day, so they passed test 2. And crucially, they had access to government money through the TARP program, so they passed test 3. Or look at a company like Hertz, often drowning in debt, but its ability to just keep borrowing money from capital markets kept it running for years. It was passing test 3, even when everything else looked really shaky. Okay, so if the rules for survival are that flexible, that kind of leads us to another big question, this one about a topic we all love to worry about: debt. We're all conditioned to freak out about those big, scary debt numbers, but are we even looking at the right thing? You know how it is. Every single time you see a news report, it's about the trillions of dollars in national debt or the billions some company owes. They flash that huge number on the screen, and the number itself is supposed to be the problem. Our gut reaction is to think, oh, that's a disaster. But what if we're all looking at the wrong number? What if the headline is actually the least important part of the story? When you really break it down, there are 3 distinct parts to any debt. First, the amount. How big is the loan? Second, the terms, the interest rate, when you have to pay it back. But then there's this third factor, one that almost always gets ignored. What was the money actually used for? And here it is, the key insight that so often gets lost in the noise. That third factor, how productively that money was used, is, by a long shot, the most critical thing for figuring out if debt is good or bad. It's not about how much you borrow. It's all about whether that borrowing creates more value than it costs. Let's think about it like this. Historically, the U.S. government took on debt for things like the GI Bill. That educated an entire generation and supercharged the economy for decades. It borrowed money to build the roads and networks that enabled the whole tech boom. That's productive debt. It generates a return in jobs, in innovation, in new taxes that's way bigger than the original loan. Unproductive debt, that's the opposite. It's borrowing to pay for things that have little or no long-term economic kickback. That's the kind of debt that becomes a real problem down the line. So this idea of productivity brings us to the very structure of a company itself. And you guessed it, another deeply held belief that we need to take a closer look at. If you've ever taken a business class, you've heard one story about who a company is supposed to serve. But that story, it might be leaving out the most important characters. The myth, the one we hear all the time, is that a public company's main goal, maybe its only goal, is to jack up its stock price for what the source material calls outside passive minority investors, or OPMs. Basically, that's us, the general public buying a few shares. The story goes that every single decision is made with an eye on that stock ticker. But our source material says this view is just fundamentally backward. It's, and I love this quote, akin to studying the solar system by assuming the sun revolves around the Earth. It puts this small, relatively weak player at the very center of the universe and completely ignores the massive gravitational forces that are actually running the show. The reality is, a company's financial structure, its whole mix of debt and stock, is a giant compromise. It's a balancing act. You've got creditors, you've got management, you've got regulators, and even just industry tradition all pulling the strings. And the outside shareholders, the OPMIs, we're often just a tiny little slice of a very big, very complicated pie. And out of all these groups, you've really got to pay attention to the creditors. See, unlike a shareholder who can just sell their stock in a heartbeat, the creditors, the banks, and bondholders who actually lent the company money, they're locked in. Their money is really on the line. And because of that, they're often way more informed, have way stricter rules, and have a much, much bigger say in a company's financial decisions than any of the stockholders do. So, what does all of this actually mean for you? if solvency isn't what we thought it was, if debt is really about productivity, and if shareholders aren't the center of the corporate universe, how are we supposed to look at the economy? Well, let's build a new playbook. Once you understand these principles, you start to see companies not as just good or bad, but as having different risk strategies. A company with low debt, that's basically an insurance policy. Yeah, its returns might be a little lower when times are good, but it's much safer if there's a downturn. A company with a ton of debt is making a big bet. It's using that debt to juice its potential returns, but it's also making any potential losses that much bigger. Neither one is wrong. They're just playing different games. This new way of looking at things completely shifts your focus. The conventional view, it's obsessed with quarterly earnings reports and the daily dance of the stock price. The fundamental finance approach looks deeper. It looks at the quality of the company's assets, its overall creditworthiness, and that complex web of relationships it has to manage. It's really the difference between just watching the scoreboard and actually understanding how the game is played.
So let's just wrap it all up. The whole creditworthiness code really boils down to these three key ideas. First, the 1 of 3 rule. Solvency is way more flexible than we're taught. Second, it's productivity over amount. What you do with the debt is what really matters. And third, it's not all about the shareholders. A company is serving a lot of different masters, and often the creditors are sitting at the head of the table.
Look, this isn't just some abstract theory. It's a powerful new lens. The next thing you see a headline screaming about a company's massive debt or a country's deficit, you can ask the right questions. Are they still liquid? How are they actually using that debt? And who are they really trying to keep happy here? Now you've got the code to understand what's really going on in the financial world around you.
Welcome to The Explainer. Today, we're going to break down what risk really means when you're investing. We're going to cut through all the noise from the headlines and the daily market chatter to focus on the one thing that can permanently, and I mean permanently, affect your money. So here's what we've got lined up. We're going to kick things off by completely rethinking what we mean by risk. Then we'll get into the 2 crucial types you absolutely have to know about. We'll break down what real, tangible risk is made of, and then, this is a good one, we'll reveal a little secret the wealthy use to avoid it. And finally, we'll wrap it all up with a practical playbook you can use to protect your own capital. All right, let's dive right in. We all tend to connect those big market downturns with a feeling of anxiety. And hey, for good reason, right? The original playbook for investing, Graham and Dodd's security analysis, just nailed this feeling perfectly.
So this quote seems to back up our biggest fears, doesn't it? A company starts to struggle, the price of its stock or its bonds goes down, and boom, investors feel anxious. It seems like a simple cause and effect. But here's the question our source material really wants us to ask. Is that it? Is feeling anxious the same thing as actually being at risk? And this is where the whole script flips. We're being challenged to think about this in a totally different way. The argument is that for a smart, sophisticated investor, that downward spiral, the very thing that's making everyone else anxious, is exactly where the opportunity starts. That is, as long as you're focused on the right kind of risk. So this all hinges on understanding the difference between 2 totally fundamental types of risk. I want you to think about it like this. You've got the storm raging on the surface of the ocean. It's chaotic, it's scary, it's unpredictable. And then you've got the structural integrity of your ship, which is what's going to determine whether you actually sink or not. And here's where we draw that line in the sand. On one side, you have market risk. That's all the noise, the day-to-day volatility. It's that feeling of anxiety you get when you see those unrealized losses on your statement. But on the other side, you have investment risk. And that's the real and present danger of losing your money for good, because the business itself, your ship, actually fails.
Now this is a total game changer of a concept. According to our source, value investors pour all of their energy into protecting themselves from permanent loss, not from temporary price swings. They believe, and this is key, that the absolute best opportunities are born when market risk is sky high and everyone else is freaking out, because that's when they can calmly step in and analyze the true investment risk.
Let's look at a real-world case study from the source material, Kmart, back in 1995. The market was in a full-blown panic. Everyone was predicting bankruptcy was just around the corner, that they'd stop paying interest on their debt. The headlines were just screaming disaster. This was a classic case of incredibly high market risk. But the investment view was the complete opposite. A deep dive into the numbers showed that even if the absolute worst happened, a bankruptcy, Kmart's senior debt was so well protected by the company's assets that the bondholders would almost certainly get 100% of their money back. So get this, there was very little investment risk, even while the market risk was completely through the roof.
Okay, so how do you actually do that? How do you properly analyze that investment risk? Well, the source gives us this really powerful three-part framework that helps you build a complete picture of what you should be looking for. The whole process really breaks down into these 3 steps. First, you've got to analyze the company itself. That's the quality of the issuer. Then you have to dig into the specific thing you're buying, the terms of the issue. And finally, and this part is the absolute kicker, you look at the price of the issue to see if it's cheap enough to give you a massive cushion. And this idea just flies in the face of what a lot of academic finance teaches, which kind of assumes that prices are always more or less correct. But in the world of value investing, when market panic pushes a price way, way too low, you get this amazing situation where you have less risk of permanent loss and at the same time, more potential for reward. It completely turns that old more risk for more reward idea on its head. All right, let's take a bit of a provocative turn here. You've heard the saying, there's no free lunch, right? It means you have to take on risk if you want to get returns. Well, the source argues that the truly, truly successful investors have a completely different motto. The secret to building a massive fortune, it turns out, isn't about taking on smart investment risks. It's about avoiding them as much as humanly possible. A lot of times, that means figuring out how to lay that risk off on somebody else. It's about making sure that at the end of the day, you're not the one stuck paying for lunch. And here's a list of folks who have absolutely mastered this art. What do they all have in common? They have structured their deals so they get a shot at all of the upside with little to none of the downside risk of actually losing their capital for good. That risk, it's been cleverly shifted over to other people. This witty little description of a limited partnership just captures this idea of risk shifting perfectly, doesn't it? The general partner, or GP, they collect their fees no matter what happens, while the limited partners, the LPs, are the ones who bear all of the actual investment risk. So the big question is, how can you, the individual investor, or what the source calls an outside passive minority investor, an OPMI, play a smarter game? How do you avoid being the one who's left with just the experience? Well, here's your playbook. Rule number 1 is the absolute bedrock of value investing. For an OPMI, someone like you or me who doesn't have any control over the company, a reasonable price just isn't good enough. No way. You have to demand a real, honest-to-goodness bargain to create that margin of safety that protects you from all the things you can't possibly know. So here they are, your core principles. First and foremost, you focus on high-quality assets. Then, and this is huge, you have to learn to deliberately ignore the market's daily mood swings. You become a hunter for growth that the market hasn't spotted and priced in yet. And maybe the hardest part, you have to be patient and just hold on, unless the fundamental reason you bought the investment truly changes. And that brings us to this powerful final idea that really ties everything we've talked about together. It comes to us from the father of value investing himself, Benjamin Graham. This just sums up our entire explainer perfectly. Market risk, that's the daily poll. It's a popularity contest based on votes. It's emotional and it changes all the time. But investment risk, that's about the real underlying substance. It's about the actual weight of a business's assets and its ability to make money. So your job as a smart, prudent investor is to tune out the constant noise of that voting machine and focus all of your energy on getting out your scale and accurately measuring the weight of the asset. The votes are just a distraction. The weight is reality. And that's the crucial question I want to leave you with. When you look at an investment, what are you doing? Are you just counting the votes, trying to guess what's popular? Or are you doing the hard work of measuring its true weight? Because making that shift in focus from market sentiment to business fundamentals is the key to minimizing the only risk that truly, truly matters, the permanent loss of your capital. So, picture this. A company like Apple or Google rakes in billions of dollars in profit. Now they've got this huge pile of cash and a really tough question to answer. What do they do with it? Do they send it back to you, the shareholder, or do they plow it right back into the business?
It sounds simple, but this one decision tells you everything you need to know about how a company thinks. And that really gets us to the heart of the matter, the central tug of war in this whole discussion. When it's time to decide what to do with profits, who comes first? Is it the company itself with all its needs for growth and, just staying safe? Or is it the shareholders, the people who put up the money in the first place and are, understandably, expecting a return? You've basically got two camps here, two warring philosophies. In one corner, you have the traditional way of thinking, the stockholder first view. This idea says, hey, the company works for the shareholders, so the whole payout strategy should be about making them happy. But then there's this other, more radical idea, the company first view. And it argues that the corporation's own needs are paramount, and shareholders, well, they get the leftovers.
Even the absolute legends of investing, Benjamin Graham and David Dodd, they kind of landed on this stockholder first side of things. Their logic was pretty straightforward. If the market really loves your stock and gives it a high valuation, it means you're really good at making money. So you should probably keep those profits and reinvest them to make even more money for your shareholders. It's a powerful argument for sure. But what if it's not the full picture? That's the idea we're going to challenge today.
All right, so here's our game plan. We're going to start by really digging into that fundamental clash of ideas. Then we'll look at why holding on to cash can be a company's secret weapon for growth. We'll get into the pros and cons of old-school cash dividends, and then tackle the much trickier world of stock dividends. After that, we'll explore the powerful and kind of controversial option of stock buybacks before we finally land on our company-first final verdict. Okay, let's dive right in. This isn't just a squabble over who gets the money. It's way deeper than that. It's a clash of philosophies. What is a company's real job? Is it to keep the stock market happy day to day, or is it to make sure the company itself survives and thrives for the long haul? The whole company-first approach is built on this one simple but powerful word, residual. A residual is just what's left over. So the idea is, a company should use its cash for all the important stuff first. Expanding the business, keeping a safety cushion, paying down debt, and only after all that is taken care of, should it even think about paying out the leftover residual cash as a dividend. Right, so if paying dividends is at the bottom of the to-do list, what's at the top? Well, that brings us to the real heart of the argument for retaining earnings. It's about using that cash to fuel the engine of growth. And if you want a perfect real-world example of this, just look at the insurance industry. For decades, property and casualty insurers had this brilliant, simple playbook. They'd pay out about half their investment income as dividends and reinvest the other half. And the amazing thing is, even in years where their main business of writing insurance policies wasn't doing so hot, this strategy created a compounding machine. That reinvested cash just kept growing and growing and growing. So when is hanging on to cash an absolute no-brainer? Well, think about the early days of giants like IBM or Microsoft. Can you imagine if they were focused on paying dividends instead of, building the future? Every single dollar was way more valuable being plowed back into the business. It's also critical when a company isn't sure it can just go out and raise more money, or when it has a golden opportunity to pay down debt. In any of these cases, sending cash out as a dividend would be a massive distraction. Now, hold on. This doesn't mean dividends are always a bad move. Not at all. So let's talk about the good old-fashioned cash dividend. When does it actually make sense for a company to cut a check to its shareholders? I mean, from a stockholder's point of view, what's not to love, right? Everybody gets one, taxes are often pretty favorable, and here's the kicker. You get cold, hard cash in your pocket without having to sell a single share of your stake in the company. It's easy to see why investors are big fans. But let's be real. A company's decision to pay a dividend isn't always pure generosity. It's often a really smart strategic move. For a utility company that needs to constantly raise capital, a stable dividend is like a magnet for investors. For another company, it might be a defensive play to keep shareholders happy and ward off a potential takeaway. So you see, sometimes paying a dividend isn't just giving away money. It's a calculated investment in the company's own stability and reputation. Okay, let's shift gears and talk about something a lot trickier, the stock dividend. Instead of cash, the company just gives you more shares. On the surface, that sounds pretty good, right? Well, it turns out it's a lot more complicated than it looks. So the pitch goes something like this. The company pays you with new stock certificates, more paper. If you want cash, no problem. You can just sell those new shares. And the big selling point is that it's supposed to be tax efficient. You get taxed at capital gains rates, which are often lower than the rates on regular dividend income.
But here's the hidden trap, and it's a big one for the company. Just look at this table. If a company that pays a $1 cash dividend also issues a 5% stock dividend every year, its cash obligation starts to snowball. Why? Because every year it has to pay that same $1 cash dividend on more and more shares. After just 10 years, its annual cash payout has jumped by over 60% just to keep the same dividend rate. It's a compounding nightmare.
And it gets worse. For the company, stock dividends are a total administrative headache. They have to adjust all their historical numbers, mail out certificates. It's a mess. And for you, the shareholder? Honestly, a lot of people just see it as more paper and more paperwork. Plus, and this is a big one, if you sell those new shares to get your cash, you're actually diluting your own ownership percentage in the company. You're watering down your own piece of the pie. So if stock dividends are kind of a mess, what's a more direct approach? Well, what if the company just takes its extra cash and uses it to buy its own shares back from the open market? This is the world of stock buybacks. Now, for shareholders, buybacks have some pretty clear advantages. First off, participation is totally optional. You don't have to sell if you don't want to. If you do sell, the cash you get is usually taxed as a capital gain. And if you decide to hold on, well, your slice of the company just got a little bit bigger because there are fewer shares out there. The main downside? Sometimes a big buyback can make you feel pressured to sell at a price you think is too low. And for the company itself, buying back stock means fewer future dividend payments, and it gives a nice automatic boost to metrics like earnings per share. But it is loaded with challenges. There are all sorts of legal hurdles, and you have this fundamental conflict of interest, right? The company, as the buyer, wants the lowest price possible, but its own shareholders, the sellers, want the highest price possible. It's a tricky situation. You know, for a long time, buybacks were seen as pretty suspicious, almost like a way to manipulate the stock price. But that all changed back in 1977, when a blue-chip behemoth like IBM launched a massive tender offer for its own shares. It was like a stamp of approval. That one event was a total game changer, giving buybacks a whole new respectability and paving the way for them to become the mainstream corporate tool they are today. So, after going through all these options, retaining earnings, paying cash, issuing stock, buying back shares, where does that leave us? Let's bring it all home and lay out the final word from the company first perspective. The logic follows a very clear pecking order. First, and most important, the company has to guarantee its own survival with a solid financial cushion, a margin of safety. Second, it has to fund every single profitable investment and expansion opportunity it has. Third, it should use any extra cash to make its balance sheet stronger by paying down debt. And only when all those other priorities have been met, should it even consider distributing the leftover residual cash to its shareholders. So here's the crucial takeaway. A company's dividend or buyback policy shouldn't be what dictates its strategy. It has to be the other way around. The payout policy should just be the natural result of a sound business strategy, one where the long-term health and the needs of the corporation itself always come first. Period. And that leaves us with one last thing to think about. The next time you see a company you own cheaping all of its profits and not paying a dividend, ask yourself this. Is it neglecting you by holding on to that cash? Or is it actually enriching you by reinvesting that cash in the most productive, profitable way possible? The answer to that question, well, it tells you everything.
When you hear stock dividend, what pops into your head? Probably just a nice, simple cash payment, right? A little reward for owning a piece of a company. But that's barely scratching the surface. The truth is, dividends are a huge part of a much bigger, much more interesting strategic game. And in this explainer, we are going to pull back that curtain and show you what dividends are really all about.
So here's how we're going to do it. We're going to start with the basic definition of a dividend, the one you'd find in a textbook. And then we're going to pick it apart. We'll look at the 3 classic theories that have shaped finance for decades, show you where they fall short, and then introduce a much better framework. The 6 real roles of dividends. We'll even walk through a real-world example and hopefully give you a totally new lens to look at your own portfolio.
All right, so let's start at the beginning. What exactly is a dividend? The definition seems simple enough, but there's a little detail hiding in plain sight that honestly changes the entire picture.
Okay, so a cash dividend is just money a company pays out to its shareholders from its profits. Simple, right? But here is the most important part of that definition. The company, meaning management, calls all the shots. They decide how much, and they decide when. If you're an outside investor, you have zero control. And that power dynamic, that's the key. It's the reason why all those old school theories just don't quite hold up. You know, for decades, the whole debate about dividends really came down to three major schools of thought. These are the theories that you'd find in any Finance 101 textbook, and while they've been super influential, each one looks at the world through a very specific and, as we're about to see, kind of flawed lens.
First up, you've got John Burr Williams. For this guy, dividends were everything, like the whole point. He argued that the only reason you'd ever own a stock is for the future cash payments it's going to give you. So in his view, a company's value is just all of its future dividend checks, added up and adjusted for today's money. It sounds clean, simple, and, well, maybe a little too simple.
And then, bam, 1958 rolls around, and these two guys, Modigliani and Miller, just drop a bombshell in the financial world. They came out and argued that dividends are completely irrelevant. Doesn't matter. As long as management is acting in the shareholders' best interest, it makes no difference if they pay you cash or reinvest it in the company. $1 in your pocket is the same as $1 in the company's bank account. I mean, what a radical idea for the time.
And finally, you've got the perspective from the absolute legends of value investing, Graham and Dodd. They weren't so much about abstract theories. They were looking at how the market actually behaved. And what they saw was pretty clear. Companies that paid out bigger dividends tended to have higher stock prices. They basically subscribed to the old, a bird in the hand is worth two in the bush philosophy. Investors just like getting that cold, hard cash.
So you've got three famous theories, and they all say something completely different. But what happens when you drag them out of the academic ivory tower and into the real, messy world of the stock market? Well, that's when you start to see the cracks in the foundation, and trust me, they're pretty big. Let's start with Modigliani and Miller's dividends are a relevant idea. It all sounds great, but it hinges on one single, absolutely massive assumption, that management is basically a saint, always selfless, always working perfectly in the best interest of every single shareholder. Now, let me ask you, does that sound like the real world to you?
Yeah, not so much. In reality, conflicts of interest are everywhere. Management isn't just serving stockholders. They're juggling the demands of creditors, unions, their own staff, a dozen different groups. And they often see outside investors as just, names on a spreadsheet. I mean, think about it. The fact that we have this entire elaborate legal system with things like the SEC is all the proof you need that what's good for management isn't always what's good for shareholders.
And John Burr Williams' theory has a similar blind spot. He assumes the only reason anyone invests is to get cash dividends, but that's just not true. So many investors, whether they're giant corporations or just regular people, are playing a different game. They're focused on wealth creation, on growing the value of their investment over time, not just cashing checks along the way. Now, Graham and Dodd were right that the market often loves a good dividend. But that's not the whole story, is it? Because a company that pays out a low dividend gets to keep more of its earnings. And if they can reinvest that cash smartly, it could fuel way more growth down the line. That could make the stock a much, much better buy in the long run, even if its price is a little lower today. Okay, so if these classic famous theories all have some pretty big holes in them, what's a better way to think about this? We need a framework that's more practical, one that actually reflects how things work in the real world. And that brings us to the 6 real roles of a dividend. And here they are, the 6 real jobs a dividend does. It can be a powerful market signal, a psychological safety net, a money-making engine for pros, a legal must-have, a sweet tax deal, and even a shareholder's last-ditch escape plan. Let's break each one down. So first up, market impact. And this is exactly what Graham and Dodd were talking about. When a company changes its dividend, whether they start one, raise it, or heaven forbid, cut it, they are sending a massive signal to the market. It's management's way of telling everyone how confident they are about the future. The market listens very, very closely, and stock prices move because of it. It's why those dividend announcements are such a big deal every quarter. All right, role number 2 is all about psychology. Think about it. If you're an investor and you're maybe a little skeptical about the company's accounting, or you just don't fully trust management, a dividend payment is like a dose of truth serum. It's not a promise on a piece of paper. It's real money hitting your bank account. It's that bird in hand that calms your nerves. It's a powerful placebo that builds trust when fancy words in an annual report just won't cut it. Okay, this next one, cash carry, this is a little trick the pros love. It sounds technical, but the idea is actually super simple. Imagine you can borrow money to buy a stock. If the dividend income you get from that stock is more than the interest you have to pay on the loan, you have what's called a positive cash carry. You are literally making money just for holding the stock. We're going to see a perfect example of this in just a minute. Now, this rule is kind of wild because it's not about what investors want to do, it's about what they have to do. A lot of huge institutions, think pension funds, trusts, endowments, they operate under these strict rules, sometimes called legal lists, that say they can only invest in companies that have a long, stable history of paying dividends. So for these giant multi-billion-dollar players, no dividend, no deal, period. This creates this huge, permanent base of demand for these kinds of stocks. You know, a dollar is a dollar, but not all dollars are taxed the same way. In the US, for instance, qualified dividends usually get taxed at lower capital gains rates. That's a much better deal than the higher ordinary income tax rates you'd pay on, say, interest from a bond. This tax break alone makes dividend-paying stocks way more attractive for a whole lot of people, which just adds another layer of demand.
And that brings us to our last role, and honestly, this might be the most important one of all, the investor bailout. Just imagine you're a minority shareholder in a company. You don't have any real power, you don't get a say in how things are run. How do you actually get your money out? Sure, you can try to sell your shares, but what if the stock is illiquid? What if there are no buyers? The dividend, my friend, is your only guaranteed way to get cash out. It's your escape hatch.
Whew, okay, that was a ton of theory, right? Let's make this super clear and look at a real-world example of that third role we talked about, the cash carry. This is a fantastic illustration of how dividends can be a profit machine all by themselves. Okay, let's walk through the numbers. Check this out. Back in 1979, you could have bought 10,000 shares of a stock called Source Capital Preferred for $240 grand. Now, let's say you didn't have all that cash, so you put down half, $120,000, and you borrowed the other half. Now for the fun part. The annual dividend from those shares would bring in $24,000. But the interest you had to pay on your loan, only $9,000. So you're left with $15,000 in pure net cash gain. On your own cash investment of $120 grand, that's a 12.5% return. And that's before the stock price has even moved a single penny. That is the magic of a positive cash carry. So we've gone on quite a journey here, haven't we? From those simple but flawed textbook theories all the way to a much more powerful and realistic framework. The biggest takeaway is this. A dividend is never just a dividend. It's a complex tool with a whole bunch of different uses. So from now on, when you see a company's dividend, don't just see the cash payment. See it for what it truly is. It's a message. It's a signal. It's a tool. It's management communicating with you. So the real question is, have you taken a look at your own portfolio through this new lens? What messages are your investments sending you?
So what if I told you that the single most watched number in the entire stock market is, well, kind of misleading? Today we're going to challenge some of that conventional wisdom about what makes a company truly great. We're going to build a completely new framework for how to look at a company's leadership, one that goes way beyond the headlines to find out how real, lasting value is actually created.
You know the drill. Every single quarter, the entire market just holds its breath, waiting for one number: earnings per share, EPS. It's treated like the ultimate report card for management. But is it really? Is one single short-term number the best way to judge the people steering the ship? Well, we're going to argue today that it's not even close.
All right, so here's the game plan for how we're going to break this all down. First, we're going to tackle that obsession with quarterly earnings head-on. Then, we'll introduce you to a really powerful framework called the 3 Faces of Management. From there, we'll dive deep into the real engine of wealth creation, and that will set us up for a little showdown between 2 investment philosophies, the famous GARP and a much lesser-known approach called GADC. And finally, we'll give you a brand new lens to see the market with.
Okay, let's jump right in with a really foundational idea. The absolute best managers out there, they're not playing the same game as everyone else. They're not focused on the short-term numbers. They're focused on a much, much bigger prize, creating sustainable, long-term wealth.
See, most of the market has this kind of tunnel vision. They judge a company's leaders as if they're just operators. You know, their only job is to squeeze out as much profit as possible this quarter. But here's the secret the best leaders know. Chasing those reported earnings is often the worst way to build real, lasting wealth, mostly because it's so heavily taxed. Instead, they focus on other, way more powerful ways to create value for investors who are in it for the long haul.
So if just being a good operator isn't enough, what's missing from the picture? Well, to really get it, we need to start seeing leadership in 3 dimensions.
And here they are,
the three faces of management. First, you've got the operator. Yep, this is the person running the day-to-day business, keeping the lights on. It's essential. But they also have to be an investor, deciding how to use the company's money. You know, what businesses to buy, what assets to sell, what big projects to greenlight. And third, they have to be a great financier who's responsible for getting the money they need on the best possible terms. The truly great management teams, they are masters of all three, not just the first one.
And when a management team nails all three of those roles, this is what you start to see in practice. It's not just about running the factory a little more efficiently. No, it's about having a rock-solid balance sheet so you can make smart acquisitions when your competitors are weak. It's about having such an incredible reputation that you can borrow money on amazing terms. These aren't the tools of an operator. These are the tools of a master investor and financier.
All right, now we're getting to the real heart of it all, the engine that truly drives value. It's this concept called resource conversion, and once you get it, you start to see how traditional accounting can actually hide the most important parts of a company's story.
So what on earth is resource conversion? Well, it's really management putting on their investor and financier hats. It's the active, opportunistic, and sometimes risky process of taking all the company's resources, its cash, its stock, its reputation, and literally converting them into something more valuable. This is where the real magic happens, but it's also where the big mistakes can happen too.
Let's just put these two side by side to make it crystal clear. On one hand, you've got your operating earnings, the profits from the day-to-day business. Super important, sure, but also super heavily taxed. On the other hand, you have resource conversion. Think of a brilliant acquisition or a tax-free spin-off of a division, or buying back a ton of stock when it's cheap. These kinds of moves can create massive long-term value, and often in a much more tax-friendly way. But, you know, not every big move is a home run. So what happens when management makes a bad call in their role as an investor? Well, you often see this thing called big bath accounting. It's basically when a company takes a gigantic one-time charge to write off a bad investment. It's kind of like ripping off a Band-Aid. Take all the pain at once so that future earnings look cleaner.
And this quote just nails it. It completely reframes everything. The market usually sees a non-recurring charge and thinks, okay, that's a one-off thing, let's just ignore it and focus on the future. But this view says, no, there's no such thing as a one-off. That charge is the accounting tombstone for a past investment mistake. It's a direct grade, a big fat F, on management's performance as an investor.
So with that whole framework in mind, let's finally look at two competing ways of finding great companies. And we're going to start with the most popular kid on the block, the one you hear about all the time, GARP, which stands for Growth at a Reasonable Price.
The GARP playbook is really laser-focused on the income statement. It's all about trying to forecast future earnings, and usually that just means drawing a straight line from the past into the future. It loves popular industries and what everyone else is thinking, but here's the critical flaw. It almost completely ignores the balance sheet. And the biggest danger? It pushes you to buy the hottest trends right when they're at their peak and their price is sky high. And if GARP has a favorite tool in its toolbox, it's the PEG ratio. It's a pretty simple formula, really. You take the price-to-earnings ratio and you divide it by the expected earnings growth rate. The rule of thumb is, if that number is below 1, it means the growth rate is higher than the PE ratio and the stock is considered an attractive growth at a reasonable price investment.
To see how this works in the real world, let's rewind to Apple back in 2012. Analysts were expecting absolutely huge earnings growth. The stock's PEG ratio was just 0.55. For a GARP investor, this was a textbook, no-brainer, screaming buy. You had massive growth, and you were paying what looked like a really reasonable price for it. It was a perfect fit for the GARP model.
Okay, so that's GARP. Now, for the other side of the coin, the alternative. If GARP is about forecasting and following the crowd, GADCP, growth at dirt cheap prices, is about something completely different. And it aligns perfectly with our three-dimensional view of management.
So where does a GAD-CNDP investor go hunting for growth? Well, they're not staring at spreadsheets trying to predict next quarter's earnings. They are digging around in all the places GARP is too afraid to go. They find growth in smart acquisitions, in hidden assets just sitting there on the balance sheet, in big corporate restructurings. This is growth that comes directly from management being brilliant investors and financiers. This is growth from resource conversion.
And this old-school example of Society Corporation from the 60s is just perfect. On the surface, this company was a dog.
It was a bank with a terrible track record, a tiny return on equity of just 3%. A GARP investor looking at its past earnings would have run for the hills. But a GAGP analyst saw clues that everyone else was missing.
And would you just look at the results? It's insane. In only 4 years, management woke up the bank's sleepy assets and put them to work. The return on equity didn't just get a little better, it quadrupled to match the industry average. Operating earnings more than tripled, growing at a mind-boggling 35% compounded rate. And the key takeaway here is that none of this growth could have been predicted from the past. It was unlocked from the balance sheet. It was a pure, unadulterated resource conversion success story. So, this really brings us to a choice, doesn't it? We've just explored two fundamentally different ways of looking for growth. And it's not just a different technique, it's a completely different lens for viewing the entire market.
So here it is, the final showdown, side by side. You've got GARP on the left, it's all about the forecast, the short-term game, following the crowd, and it only sees one face of management, the operator. And then you have GAD-ECP on the right. It's about the real assets you can touch today, the long game, thinking for yourself, and most importantly, appreciating that management has to wear all three hats: operator, investor, and financier.
And that leaves us with one final question, really. A question for you to think about. When you look at a company, are you just looking for the popular growth that everyone else already sees and frankly is already paying for? Or are you willing to do the deeper work, to roll up your sleeves, look at that balance sheet, appraise management in all three of their dimensions, and hunt for the hidden value that almost everyone else has missed?
Welcome to The Explainer. Today, we're going to dig into a really fundamental idea in investing, something based on the work of Martin J. Whitman and Martin Shubik. We're going to challenge this notion that your stock's daily price is the only report card that really matters.
Okay, let's just jump right in. Every single day, you and we're told that the stock ticker is the ultimate scorecard. You know, green is good, red is bad. Sounds simple, right? But is that little flicker of numbers on the screen, is it really telling you the whole story about what your investment is actually worth?
I mean, this idea is everywhere. It's all over the financial news, it's on our investing apps, it pops up in our conversations, and it creates this really powerful story that the daily market value of your portfolio is the one and only way to know if you're winning or losing the game.
But what if that so-called common sense is just, well, a massive distortion of reality? The core argument we're going to explore today is that the importance of that daily market price changes. It changes dramatically depending on who you are as an investor. For some people, yeah, it's everything. But for others, it's almost a footnote.
So this brings us to a whole new way of thinking about it. Instead of seeing market performance as this all-or-nothing measure of success, what if we assign it a weight? You know, how much should that daily price swing actually matter to your specific strategy?
And this whole idea of weighting, it actually has a pretty fascinating history. It comes from old legal cases where courts had to figure out a company's fair value. And they wouldn't just look at one number. No, they would weigh multiple factors, things like market value, earnings, and assets, to get a much more complete and, frankly, accurate picture. This visualizes the question perfectly. For most of us, the right weight to give market performance isn't 0, and it's definitely not 100%. It's somewhere in between. And figuring out where you land on that spectrum is honestly one of the most important decisions you can make as an investor.
Okay, so let's explore the extremes, starting with the 100% view. And let's be super clear, there are absolutely times when giving 100% of your attention, 100% weight, to that market price is the only rational thing to do.
If you're a day trader, or maybe you're holding an option that's about to expire, or maybe your financial situation is just so fragile that a short-term drop could be totally devastating, well, then you live and die by that ticker. For these folks, reacting to price movements isn't just a strategy, it's a survival mechanism.
This quote from GM Loeb, it just captures the mindset perfectly. It's like the gospel of the 100% weight investor. The first, last, and only rule is prevent short-term loss. The game isn't about long-term value. It's all about what's happening right now.
But for many of us, maybe even most of us, focusing only on that ticker is kind of like watching the scoreboard instead of the actual game. The real action, the stuff that's going to determine the final outcome, is happening down on the field, inside the business itself.
Let's compare two different types of investors to see exactly why. So, for someone with a fixed portfolio, a market drop is a direct, painful loss.
No way around it. But now look at the dollar averager. Think of a pension plan that's constantly getting new cash to invest. For them, a down market is an opportunity. It's a sale. It literally means they get to buy more shares at a discount, which can seriously boost their future returns.
And this gets to the most fundamental distinction we have to make. I want you to think of it like an iceberg. The number you see on the screen, the market price, that's just the tiny tip. It's the price of a small fraction of a company changing hands. But the value of the entire underlying business, that's the massive, massive part hidden below the surface. They are two totally different things.
Just think about it this way. You can easily sell, say, 1,000 shares of JP Morgan Chase at its current market price. That price is a very real realization figure for you. But could you sell all 2.9 billion shares of JP Morgan Chase at that exact same price tomorrow? No way. Absolutely not. The market couldn't handle it. The price reflects the trade of a few shares, not the worth of the whole company. This difference becomes crystal clear when you compare an outside investor with a company insider. The outsider has zero control. They see value through the stock ticker. But the insider, the person who can actually influence the business, they're worried about real-world problems, like sluggish sales or a new competitor. The stock price is secondary to the actual health of the business.
This really gets to the heart of it. So many of the things that move markets day to day, interest rates, scary headlines, a slightly missed earnings target, they're just weather. You know, they can shake the leaves, but they don't really affect the roots of the business. An investor who's focused on the fundamentals learns to look past that storm and focus on the health of the tree itself.
Okay, this next idea is a real game changer. It's a way to reframe the entire goal of investing. And it all comes down to a simple question. What is your bailout? And I promise, it's probably not what you think.
A bailout in this context has nothing to do with the government rescue. It's simply the way you get your value, your return from an investment. And the critical insight here is that selling your stock on the market is only one of several ways to do that.
And as we can see, there are three main paths. Your return can come from the market, sure, by selling to another investor. Or it can come directly from the company itself, through things like dividends or interest. Or, if you have a controlling stake, your bailout can be the power, the salary, and the perks that come with actually running the business.
Now let's connect all the dots. The more of these alternative bailouts you have, the less the daily market price matters. A bondholder gets regular interest payments. An income investor gets dividends. An insider gets a salary. See? Their return is independent of the ticker. But for a minority stockholder in a company that pays no dividend, the market price is their only bailout. For them, it is everything.
So at the end of the day, there's no single right answer here. The weight you decide to assign to market performance is a deeply personal calculation. It all comes down to your goals, your time horizon, and, most importantly, what your real bailouts are.
So, it's a question worth asking yourself. Before you check the market tomorrow morning, just take a moment and decide, how much weight are you going to give it? The answer might just change the way you invest forever. Thanks for joining me on this explainer.
Hello and welcome back. Today we're diving into Chapter 13 of our source text to tackle one of the biggest, most fundamental rules in finance. We're going to ask a question that might just shake up how you think about building a portfolio. How much diversification do you actually need?
You've heard it a million times, right? From the very first day you even think about investing, the mantra is diversify, diversify, diversify. But what if that's not the full picture? What if, for a certain kind of investor, it's not just incomplete advice? What if it's actually the wrong advice? Let's get into it.
Okay, so let's be fair. The advice to diversify, it comes from a very, very sensible place. It's not crazy. It's all about protecting yourself from a very specific and very real danger that's always lurking in the market.
Now that danger has this kind of fancy academic name, unsystematic risk, but all it really means is company-specific trouble. You know, a terrible product launch, a huge management scandal, you name it. Imagine one of your companies just implodes. If all your money is tied up in that one stock, well, you're toast. Diversification is your shield. It's your financial body armor. It spreads the damage around so that one company's failure can't sink your whole ship.
And that's the key takeaway right there. Diversification is, at its core, a defensive move. It's a hedge. It's you basically throwing your hands up and saying, look, I don't have a crystal ball. I can't possibly know for sure what's going to happen to any single company.
So who is this for exactly? Our source material is super specific about this. It's for what it calls an outside passive minority investor.
Sounds complicated, but it's simple. It's for you if, and be honest here, you don't really know the nitty-gritty of a business, you have absolutely zero say in what the company does, and you pretty much just accept whatever the market price is. If that's you, then diversification isn't just a good idea, it's your lifeline. It's essential.
But, this is a huge but, what if that's not you? What if you're playing a totally different game? Well, that's where we flip the entire script and talk about the power of the exact opposite idea, concentration.
There's this quote in the book that just nails it. It's a bit punchy, but it's so good. It's basically saying diversification is a crutch. It's what you use when you don't have knowledge, when you don't have control, and when you aren't paying super close attention to the price you're paying. And if you do have all those things, well, that crutch might just be slowing you down. So let's break this down. It's like two different sports. On one team, you have the diversifier. Their number one goal? Don't get hurt. Play defense. They're built on the admission that they don't know everything. On the other team, you've got the concentrator. They're all offense. They're trying to score and score big. And their entire game plan is built on their own deep knowledge and their hunt for a bargain. It's a totally different mindset, a completely different world.
Okay, this is where it gets really, really interesting. How do you actually figure this out for yourself? How do you translate your edge, your advantage, into how your portfolio should look? Well, believe it or not, there's a fascinating tool that helps us think this through, and it's called the Kelly formula.
Whoa, okay, I see a formula. Don't click away. I promise we are not doing a math quiz here. The real power of this thing isn't in the calculation, it's in understanding the ingredients. Think of it less like an equation and more like a recipe for making smart bets.
It's actually super intuitive when you break it down. P is just your confidence. What's the probability that you're actually right about this investment? B is the payoff. If you win, how much bigger is the win compared to what you lose? And F, well, F is the magic number. It's the answer. It tells you the optimal slice of your capital to put into that single idea.
All right, let's put this into practice with a few different investors. First up, the passive indexer. This person believes the market is pretty much efficient. Their edge is paper thin. Maybe they're right just 50.5% of the time. So what does the formula tell them? It says bet tiny. Put just 1% of your money into any single stock. And what's the logical result of that? You need to own 100 different stocks. Boom, classic. Wide diversification.
Okay, now let's meet the value investor. This person does their homework. They hunt for bargains. So their odds are a bit better, say 52%. Now the formula says, hey, you've earned the right to bet bigger. It suggests putting closer to 8% of your capital into each idea. And just like that, the optimal portfolio suddenly has only about 13 stocks. See the difference? That's focused concentration.
And then you get to the extreme. Let's call this person the buyout pro. We're talking about someone with deep knowledge, direct control over the business, and access to incredible financing. Their odds of winning are huge, let's say 70%. You know what the formula tells them to do? Go big. Bet half, 50% of their capital on a single deal. Their whole world is just two investments at a time. That is hyper-concentration.
So the pattern is crystal clear, right? The bigger your edge, the fewer bigger bets you should make. But what's the catch? What's the trade-off for having that kind of conviction? Let's look at the results.
And wow, this chart from the text just says it all. Over the long run, the concentrated portfolio, the one that made the bigger, smarter bets, doesn't just win, it crushes it. It grows to 9 times its original value. And the over-diversified one, using the very same stock picks but spreading the money too thin, it only triples. The difference in the final outcome is just staggering.
But, and you knew there was a but coming, right? Here it is. That incredible performance comes with a price tag. And that price is volatility. The journey for that concentrated portfolio is a much, much bumpier ride. You have to have the stomach to handle the scary downswings to actually get those huge long-term rewards.
And this really reframes what the goal of investing should be. It's not about trying to win every single quarter or every single year. The true measure of success is your total return over a very long time. That lumpiness in your performance, it isn't a sign you're failing. For this kind of investor, it's a feature, not a bug. It's part of the price of admission.
Which brings us to what might be the single most important point of this entire discussion. The whole debate, diversification versus concentration, it really just boils down to one thing: knowing who you are as an investor.
So take an honest look at this table. Where do you really fit? Are you the person with the deep, specialized knowledge? The person with some control who only buys at a bargain? Or are you operating with less information and generally accepting the market's price? Be brutally honest with yourself, because your answer to that question should dictate your entire strategy.
At the end of the day, there is no single right answer. There's no one-size-fits-all solution here. The right strategy for you is personal. It's a direct reflection of your own knowledge, your own control, and your own discipline. It's a reflection of your true, demonstrable edge.
So I'll leave you with this one last thought. Go take a look at your own investments. Is your portfolio built like a fortress, designed for defense, to protect you from what you don't know? Or is it built like a battleship, designed for offense, to capitalize on what you do know? Your honest answer to that question tells you everything you need to know. Thanks for digging into this with us.
You know, what if one of the most fundamental ideas in all of modern finance is just flat out wrong? For decades, we've been taught that the market is efficient, that prices are always correct. But today, we're going to dig into a really powerful counterargument, a totally new way of seeing how markets actually work. And really, this is the question at the heart of it all. Are market prices always right? For decades, the academic world has given a resounding yes. The theory goes that all available information is already baked into a stock's price, which means trying to beat the market is, well, a fool's errand. But does that elegant theory actually hold up in the messy real world? All right, so here's our game plan. First, we'll dive into the official story, what we're calling the efficient market myth. Then we'll flip the script and look at the reality from a value investor's point of view. After that, we'll introduce a new 4-factor toolkit for analyzing any market, explore who really wins when there's no discipline, and see it all play out in the world of corporate takeovers. And finally, we'll rethink what fair value even means. Okay, first things first. Let's get a handle on the official story. This is the theory that has pretty much dominated financial thinking for the last 50 years, and it was born and raised in the halls of academia. It's called the efficient market hypothesis, or EMH for short. The core idea is actually pretty simple. The market is like a giant lightning-fast supercomputer that instantly processes every shred of information out there. And the result? The price you see on the screen is the one true correct price. So forget about finding those hidden, undervalued gems. The theory says if they ever existed, they'd be gone in a flash. And this quote from Nobel laureate William F. Sharpe, man, it just perfectly sums up the whole idea. Price equals value always. No exceptions. It's a really clean, really elegant concept. But as we all know, the real world is rarely that simple. Okay, so that's the theory. But now, let's step out of the classroom and onto the trading floor. Because for the practitioners, the people actually doing the work, analyzing businesses day in and day out, reality looks a whole lot different. And this slide really gets at the fundamental clash in perspectives. Academics, they take this top-down 80,000-foot view, looking at broad market data and prices. But value investors, they work from the bottom up. They get their hands dirty, digging deep into one specific company. Its assets, its real earnings power, its access to capital. They're looking for the kind of value that a simple spreadsheet model is just going to miss every time. And here, right here, is the smoking gun. Just look at this data from 2012. We're talking about profitable, solid, well-run companies trading at massive discounts to their net asset value, their NAV. Check out Wheelock & Co. It's trading for 47% off. Henderson Land, 42%. If price always equals value, how on earth does something like this happen? This is the giant gaping hole in the traditional theory, and it's exactly where value investors thrive. So, if the market is in this perfectly efficient machine all the time, then what decides when it is and when it isn't? Well, this brings us to the real heart of our explainer today. A brand new framework for understanding any market, whether it's stocks, bonds, or even corporate takeovers. Think of these as the 4 big dials that control how efficient any market is. First up, the participant. Who's in the game? Are we talking about a rookie retail trader or a deeply connected insider? Second, the complexity. How simple is the thing being traded? Is it a straightforward government bond or a super complex global company with a million moving parts? Third, the time horizon. What's the end game? Making a profit in the next 5 minutes or over the next 5 years? And fourth, and this one is absolutely crucial, external forces. Who's the referee? Who's there to enforce the rules? Regulators, lenders, an independent board? So let's see how this works. A market that's highly efficient would look something like this. You've got a regular trader, not a big shot insider, dealing in a simple product, maybe a short-term stock option, and they're up against thousands of other people doing the exact same thing. In that kind of environment, trying to get an edge is almost impossible. Price and value are going to be locked together, super tight. But now let's flip every single one of those dials. Imagine you have a highly sophisticated insider, like a CEO. They're dealing with their own complex company. They have a multi-year time horizon. And here's the key. They face very, very weak oversight from their board. Now that is the perfect recipe for an inefficient market. It's a market where certain players can consistently pull in what economists call excess returns. So let's really dig into that last point, because when that fourth factor, those external forces, is weak or just plain absent, the system creates predictable winners. And I mean predictable. This isn't random luck, it's baked right into the structure of the market. So who are these predictable winners? Well, it's a pretty exclusive club. You've got the people who engineer leveraged buyouts, you've got hedge fund managers, powerful top executives, and of course the investment bankers and salespeople who serve them. What do they all have in common? They operate in arenas where the forces that create price discipline are either incredibly weak or don't exist at all. And to give you a sense of the sheer scale of this, just think about the money management industry. Yeah, it's competitive when it comes to hiring talent, but not so much when it comes to the fees they charge. This lets insiders capture a huge chunk of the returns. How big are we talking? Well, back in 2011, just one firm, BlackRock, managed $3.65 trillion. That's trillion with a T. Now, it's really important to get this right. Those external forces, like government regulation, they're not automatically good or bad. For example, the Investment Company Act of 1940 built a ton of investor trust and helped the mutual fund industry boom. But on the other hand, a lot of people argue the Sarbanes-Oxley Act was so expensive and cumbersome that it actually scared companies away from U.S. markets. So getting that balance right is everything. All right, now for a perfect high-stakes example of an inefficient market in action, the world of corporate takeovers. This is where the whole idea of a fair price gets really, really complicated. Here's the conflict at the absolute core of a takeover. On one side, you have the willing buyer, and a lot of the time, that's the company's own management. They see the long-term potential, the real value, and they want to buy the company for less than it's truly worth. And on the other side, you've got the coerced seller. That's the public shareholder. They're usually focused on the short term, just hoping to get a quick little premium over today's stock price. And here's why we use that word coerced. An individual shareholder can't just say, nope, not selling. If a majority votes yes on the deal, you are forced to sell your shares. And guess who usually controls the whole voting process? The very same management team that's trying to buy the company on the cheap. This isn't a negotiation between two equals, not even close. It's a transaction defined by a huge imbalance of power. Okay, so let's tie all these threads together. We've kind of torn down the old simplistic model and built a new, more realistic one. So what's the big final takeaway when we think about price and value and fairness? This right here is the ultimate conclusion. The old theory says price and value are one and the same. But we've seen, in the real world, that the fair price for a regular public shareholder is a completely different universe from the fair value to an insider who wants to buy the company. And that gap isn't a mistake or an error. It's a direct result of markets where different players have different information, different goals, and wildly different amounts of power. That gap is market inefficiency in the flesh. Which leaves us with one last thought for you to chew on. If that price you see on the screen doesn't always reflect the true underlying value of a business, then what are you really paying for? Are you paying for a piece of a great business, or are you just paying for the market's ever-changing, fleeting opinion of that business? It's a question that, honestly, changes everything about how you look at the world of investing.
Welcome to The Explainer. So today, we're going to break down this really powerful investment philosophy called the safe and cheap approach. It's a method used by some of the sharpest investors out there, and you know what? It basically starts by flipping everything you think you know about investing completely on its head.
Seriously, this one question, what have I got to lose, that's the entire foundation of this strategy. Before you even think about asking how much can I make, the best in the business, they first obsess over controlling the downside. It's all about one thing, minimizing risk before you even start dreaming about the reward.
Okay, so let's jump right into this playbook. First, we'll get into the core mindset. Then, we'll go through a non-negotiable safety checklist. After that, we'll talk about when to actually buy, what the payoff looks like, and finally, what sacrifices you have to make for strategy this demanding.
All right, first things first, this is all about a complete mental shift. You've got to reframe how you think about this stuff. You're not trying to guess which way the market is going to swing. Nope, you're coming at this with the same super rigorous, super cautious mindset that a lender would before they even think about giving out a loan.
And this slide just nails the difference, right? On one side, you've got this speculator who's totally drawn in by the potential upside, often completely ignoring the risks. But on the other, you have the creditor, and by extension, the safe and cheap investor who makes capital preservation priority number one. Profit, that's a secondary concern. It only gets considered once you are absolutely sure you've established safety.
Okay, and here's where it gets really interesting. It's all about how you define risk. See, for this strategy, risk isn't about the stock price bouncing around every day. No way. The true risk is found inside the company itself. Its financial health, its assets, the people running it. The market, that's just noise. The business, well, that's reality.
So let's build on that idea and move to the very foundation of the strategy. We're going to see how this whole mindset builds into a real actionable checklist. These are the 4 essential things that every, and I mean every, potential investment has to have. Think of these 4 pillars as the ultimate gatekeepers. They are non-negotiable, an indispensable condition. If even one of these is missing, just one, the investment is an immediate no. I don't care how attractive it looks on the surface, you just walk away.
So let's really dig into that first pillar, a strong financial position. A company's finances have to be like a rock-solid immune system. What does that mean? It means it has quality assets that aren't all tied up as collateral for a bunch of debt. This is so crucial because it gives the company the resources to survive economic shocks and, even better, the strength to pounce on opportunities, like buying up a competitor or expanding its business.
Pillar number 2. This one is all about trust. You have to be absolutely confident that the people running the show are acting as responsible stewards for everyone's money, not just trying to line their own pockets. The source material actually calls them predators, and that's exactly what you're looking for, so you can avoid them at all costs.
All right, pillar 3 is all about clarity. And listen, you don't need some secret inside scoop here. What you need is enough publicly available, high-quality information, stuff like SEC filings and annual reports, to make an intelligent, informed judgment about the company's health and its value. If you look at a company and its operations are basically a black box, you just walk away. Simple as that.
And here we go, the final pillar. This is what creates your all-important margin of safety. This is where you do the work to calculate the company's net asset value, which is basically what the business would be worth if you sold it off piece by piece. You only buy if the market is offering you that stock at a huge discount to its real value. You're literally trying to buy $1 for, say, 50 or 60 cents.
Okay, so let's say a company has passed all 4 of your safety checks. It's safe and it's cheap. That's fantastic, but it's still not enough. You still need a compelling reason to pull the trigger and actually buy it right now. You need a trigger, a catalyst, something that's likely to unlock all that value you've identified.
So these buy signals, or triggers as we're calling them, they tend to fall into 3 main buckets. They can be tied to the day-to-day operations of the business, like maybe profitability is getting better. Or they can be related to huge corporate events. And, a little less commonly, they can be tied to just broad market sentiment shifting.
Now, this slide right here shows some of the most powerful triggers you can find. They all fall under this umbrella of resource conversion. And what that means is these are specific, tangible events where the company's underlying assets get converted into cold, hard cash, or maybe more valuable stock for the shareholders. A potential takeover? That's a classic catalyst that can force the market to recognize that hidden value, and fast.
All right, so you've done all the work. You've been disciplined, you found a safe and cheap stock with a good trigger, and you finally made the investment. So, what's the reward for all this patience and discipline?
And that's a totally fair question, isn't it? I mean, this approach, it demands an incredible amount of reading, a ton of analysis, and maybe most of all, a whole lot of patience. So the payoff, it better be worth it.
Well, the biggest advantage is that you have multiple ways to win. It's not a one-trick pony. Because you bought with that margin of safety, you're not just making a simple bet that the stock price is going to go up. Value can be realized through a takeover, the company can just keep growing its net asset value over time, or it could use its strong financial position to make smart acquisitions. And hey, even if you're wrong in your analysis, your downside is limited. That gives you a ridiculously powerful long-term edge.
And that confidence, the kind that's born from doing really deep research, it's like a psychological superpower.
Think about it. When the market starts panicking and stock prices are crashing for no good reason, you're not scared. Instead, you see a golden opportunity to buy more of a great business at an even cheaper price. That's a game changer.
But look, let's be crystal clear about something. This method, it's not some magic formula. It is incredibly demanding, and it requires you to accept some very specific trade-offs when you compare it to conventional investing.
You can really see here just how different the whole philosophy is. This approach prioritizes the strength of the balance sheet over Wall Street's obsession with predicting next quarter's earnings. It demands a long-term view, and it accepts that the goal is just good enough results over time. You're not trying to beat the market every single month or every single year.
You know, when it comes down to it, this strategy is defined as much by what you don't do as by what you do. It forces you to say no over and over and over again. You have to pass on popular stocks that everyone's excited about. You have to have the mental fortitude to just wait, sometimes for years, for your analysis to finally be proven right.
And really, this is the core belief that holds the whole thing together. It's the idea that by focusing intensely on the internal facts of a few hand-picked companies, their finances, their management, their assets, you can actually develop a real information advantage over the market, which is often just manic, short-term, and totally superficial. So in the end, this entire powerful playbook brings us right back to where we started. It all comes down to that initial fundamental shift in your mindset. So the next time you look at an investment, what's going to be your first question? It's not about chasing the highest returns. It's about rigorously, obsessively making sure you've controlled the risk. If you can do that, the profits, well, they'll tend to take care of themselves.
Welcome to The Explainer. You know, when you hear the term value investing, two names probably pop into your head, Benjamin Graham and David Dodd. I mean, these guys literally wrote the book on it. But what if everything they taught us was just the beginning? Today, we're going to dig into how their classic ideas have morphed into something way more dynamic, a modern framework that might just change how you see a company forever.
So, here's how we're going to tackle this. We'll start by tipping our hats to the legends, Graham and Dodd, and really get a grip on their legacy. Then, and this is where it gets interesting, we'll throw a completely different worldview into the mix. We're going to see how this new perspective totally flips the script on how value is created, what risk really means, and finally, we'll piece together what it takes to be a modern value investor.
All right, Section 1, Graham and Dodd's legacy. Look, to really get where we're going, we've got to start at the beginning, right? The entire philosophy of value investing is built on this absolute bedrock that Graham and Dodd laid down. It's the foundation for everything.
So what did they give us? Well, they gave us these 4 timeless pillars that have been the gospel for smart investors for, almost 100 years now. First, price isn't the same thing as value. So simple, so powerful. Second, investing is not the same as speculating. Huge difference. Third, you've got to have a margin of safety. It's your buffer. And fourth, make your decisions based on cold, hard facts. These aren't just, cute sayings. They are the absolute rules of the road. Okay, but here's the twist, and it's a big one. Pretty much everyone in finance knows their names, right? But hardly anyone has really dug into their work. It's created this superficial understanding. It's like everyone sees the tip of the iceberg but has no idea what's underneath. And it's in that gap, that space, where a new, more evolved approach has grown. It's called fundamental finance, and it doesn't just build on their ideas. In some ways, it challenges them head-on. Okay, Section 2, 2 competing worldviews. Now we're getting to the absolute heart of it. The entire difference between classic Graham and Dodd and this new fundamental finance idea, it all boils down to one simple question. How do you see a company? Do you see a big, steady ship sailing a predictable course? Or do you see a high-performance race car constantly being tweaked and modified? Because that one little difference, well, it changes absolutely everything. But before we get into that, let's just be clear about who we are in this story. Most of us, and I mean pretty much all of us, are what's known as an OPMI. That stands for an outside, passive minority investor. Just think about it, right? We're on the outside, we have no control, and we own a tiny piece of the pie. We can't tell the CEO what to do, we don't get the secret memos, we're just looking in from the outside. And the thing is, both of these philosophies were designed for us, the OPMI, but man, they give us a totally different set of tools. And this right here, this is the showdown. On one side, you've got the Graham and Dodd view. A business is a going concern. It's that steady ship, right? You analyze it by looking at its steady flows, earnings, cash flow, and you kind of assume the future will look a lot like the past. But on the other side, you've got fundamental finance, which sees a business as an investment vehicle. This is the Formula One car. It's dynamic. It's constantly changing through mergers, acquisitions, restructurings. So your analysis has to change too. You stop focusing so much on the predictable flows and start looking at the raw asset values. What are the parts of this car actually worth if you took it apart?
And this quote really nails it. The point isn't that one view is right and the other is wrong. It's that most companies today are a little bit of both. They have their steady, day-to-day business, the going concern part, but they're also involved in all these dynamic strategic moves, the investment vehicle part. So to really understand a company, you can't just pick one lens. You got to be able to see it through both.
Okay, Section 3, how value is created. So if we're now looking at companies through these two different lenses, what does that do to our idea of how value is even made? Well, it turns out it changes things a lot. We're about to go way beyond just looking at earnings and dividends.
The old-school Graham and Dodd view was pretty simple, right? A company earns money, the market puts a PE multiple on it, and then they send you a check in the mail, a dividend. That's how value works. But the fundamental finance view, it just blows that whole idea wide open. It shows us there are so many other, and frankly more powerful ways that a company can create value.
And this is where it gets really interesting. Yeah, of course, cash flow and earnings create value. That's day one stuff. But fundamental finance says, wait, there's more, a lot more. First, you have what are called resource conversions. Think about a huge merger or a company spinning off a division. That can unlock a ton of value overnight. And then there's this idea of having super attractive access to capital markets. Imagine a company that can IPO in the middle of a bubble. That's creating massive value out of thin air. All of a sudden, value isn't just about running the factory well, it's about playing chess with the company's assets and its place in the market.
This way of thinking totally changes how we look at cash too. For Graham and Dodd's, a company with extra cash should do one thing: give it to you as a dividend. That was the gold standard. But fundamental finance says, hold on a second. Management actually has three strategic choices for that cash. 1, they can expand the business. 2, they can pay down debt. Or 3, they can give it back to shareholders, either with dividends or buybacks. And there's no single right answer. The best move is simply whatever creates the most value right then and there. Which naturally leads to how we grade the people in charge. The old way, you just asked one question about management. Are they good operators? Basically, can they run the business day to day? But the fundamental finance framework says that's just 1/3 of the grade. You have to judge them on 3 things. 1, are they good operators? 2, are they smart investors with the company's money? And 3, are they clever financiers who know how to manage capital? It's a way, way tougher report card.
All right, Section 4, understanding true investment risk. Now this might be the biggest difference of all. It comes down to how we define risk. Think about it. When you invest, what are you actually worried about? Are you worried about the stock market having a bad day? Or are you worried about something being fundamentally wrong with the company you own? Because your answer to that question changes the entire game.
You see, the two approaches start in completely different places. Graham and Dodd's method is top-down. It's like a funnel. You start by looking at the whole economy. Then you narrow it down to the market, then an industry, and finally, you get to the company. Fundamental finance completely flips that. It's bottom-up. It's like starting with a microscope. You put one single company under the lens and analyze the heck out of it, and you pretty much ignore all the noise from the wider market.
And this intense bottom-up focus is exactly why followers of this school of thought are so, well, skeptical of diversification. This quote says it all, doesn't it? Diversification is only a surrogate, and usually a damn poor surrogate, for knowledge, control, and price consciousness. Basically, they're saying that owning a little bit of everything is often just an excuse for not knowing a lot about anything.
So let's just boil it down. What are the 2 types of risk? Graham and Dodd were worried about market risk. They were worried about the whims of Mr. Market, his crazy emotional swings that could drag your stock down. Fundamental finance, on the other hand, is laser-focused on investment risk. This is the risk that something is actually wrong with the company, that there's a crack in the foundation. One fears the crowd, the other fears the company itself.
And that means their famous margin of safety, it comes from 2 totally different sources. For Graham and Dodd, you get your safety when the whole market is on sale. During a crash when everything is cheap. But for fundamental finance, your safety comes from the specific company. It's about finding one great house, inspecting it from top to bottom, knowing it's solid, and then getting it for a bargain price, even if the rest of the neighborhood is expensive. It's the difference between a market discount and a company-specific discount.
Okay, last section,
the modern value investor. Let's pull all of this together. What does all this actually mean for us today? What's the new mindset? Well, it really boils down to this. You have to start thinking less like someone who just picks stocks and a lot more like someone who actually owns the entire business.
You know, this whole modern framework really hangs on the answer to one simple but incredibly deep question. It's a question Graham and Dodd never really dug into, which is, do stock market prices actually reflect what a company is truly worth?
And the answer from the fundamental finance point of view is a big fat no. Well, no, not necessarily. See, a stock's price can be totally disconnected from its real value, and it can stay that way for a long, long time. That gap between price and value will just sit there until something happens to close it. And that something has a name, a catalyst. It's a trigger, like a buyout offer or a big restructuring that forces everyone to finally pay attention and recognize the company's true value.
And this chart just lays it all out side by side. You've got Graham and Dodd on one side, seeing a business as a going concern, using a top-down analysis, focusing on earnings, and worrying about market risk. Then you've got fundamental finance on the other, seeing a business as an investment vehicle, starting from the bottom up, looking for all kinds of value creation, and focusing on the risk in the business itself. It's not just a small tweak, it's a complete 180 in how you approach things.
So, what should you take away from all this? It's really about adopting a new mindset. You have to start thinking like you're buying the whole company, not just a little piece of paper. You stop trying to guess what the market's going to do next, and instead, you focus on deeply understanding the business. You become a hunter, looking for those specific catalysts that will unlock the value you've found. And you start treating financial statements less like a history book and more like the first chapter of a mystery novel.
So I'll leave you with this one thought to chew on. You could say that Graham and Dodd gave us the greatest owner's manual ever written for a car's engine. It's brilliant, but is that enough anymore? To really succeed today, maybe you need to understand not just the engine, but the chassis, the suspension, and who's in the driver's seat. So, next time you're sizing up an investment, ask yourself, are you just analyzing the business, or are you analyzing the entire vehicle?
All right, let's talk about finance. You know, deep down, there are basically two warring tribes. Two completely different ways of looking at money, at markets, at the very idea of value. And today, we're going to unpack this huge clash of ideas. Because trust me, understanding it changes everything about how you see your own investments.
And you know what? It all boils down to this one simple question. When you look at a stock price on your screen, is that it? Is that the final word on what that company is worth? Or is it, I don't know, just a suggestion? How you answer that one question, that puts you in one of two very different camps. And we're about to figure out which one you're in.
Okay, so here's the game plan. We'll start with the two big philosophies, then get into what safe and cheap really means. We'll watch the great debate over price versus value, break down their core beliefs, see how it all plays out in the real world, and then wrap up by figuring out what's your investment lens.
So let's meet our two contenders, shall we? In this corner, hailing from the halls of academia, we have modern capital theory. Think professors, complex models, textbooks, the whole 9 yards. And in the other corner, coming up from the trenches, we have value investing. This is the philosophy of the practitioners, the people on the ground, actually analyzing and buying businesses.
And here's where you see the fundamental difference, right? It's all about focus. Modern capital theory, let's call it MCT, it's kind of like a meteorologist. It's obsessed with the weather patterns, the behavior of prices, the mood of the market as a whole. But value investing, that's more like a geologist. It totally ignores the day-to-day weather, and instead, it drills down to the bedrock, the actual business, its resources, its quality, its substance. Okay, so to really get the value investor's mindset, we've got to learn their language. And the two most important words in their entire vocabulary are safe and cheap. But here's the thing, they probably don't mean what you think they mean.
First up, safe. Now, for a value investor, this has absolutely nothing to do with how much a stock's price is bouncing around every day. A stock could be going on a total roller coaster ride, but if the business underneath it is rock solid, if it has a fortress balance sheet and can survive pretty much anything, a value investor looks at that and says, yep, that's safe. It's all about business durability, not market stability. Big difference.
And then there's cheap. Look, this isn't just about a low stock price. Not at all. It means you're paying a price that's way, way less than what the entire business would be worth if you, say, bought the whole thing.
It's literally like finding a dollar bill on sale for 60 cents. And that gap, that 40-cent discount, that's the holy grail for value investors. That's their margin of safety.
And this isn't just theory, okay? This stuff happens. Check out this real-world example from 1998 with Toyota Industries. The stock market was selling one share for about $16.50. But if you actually did the work, if you looked at the books and added up all its assets, you'd find that each share was really worth more than $25. That's a discount of almost 40%. You were literally buying a dollar's worth of a world-class company for 60 cents. For a value investor, that's not a stock. That's a treasure chest sitting on the sidewalk with a for sale sign.
Now that Toyota example, that huge, glaring gap between the price and the actual value, well, that's the exact thing that the other philosophy says is flat out impossible. And that, right there, brings us to the very heart of this whole debate.
Just listen to this. This is a quote from a Nobel Prize winner, William F. Sharpe, and it's basically the Bible of modern capital theory. He said, "Every security's price equals its investment value at all times." Wow. Think about that. It's an absolute statement. No discounts, no bargains. The price you see is the value. Full stop. That one sentence, it's the battle line.
So you see, we're talking about two completely different games being played on the same field. The MCT team sees the market as this perfect, efficient machine. Price equals value, always. So the goal isn't to find a bargain, because, hey, they don't exist. The goal is just to manage your risk. But the value investors, they see the market as this messy, emotional, sometimes irrational arena where prices can get totally disconnected from a company's real worth. And that is where they find incredible opportunities.
And this one single disagreement, price versus value, it's like the first domino that falls. It just knocks over everything else, leading to totally different beliefs on three other huge ideas. And the first one is, what even is risk?
All right, so for the MCT folks, risk is pretty simple. It's volatility. How much does the stock price jump around? A nice, stable stock is low risk. But for a value investor, that's not risk at all. For them, real risk is the chance that the business itself will go down the tubes, causing you to permanently lose your money. A stock price taking a nosedive isn't the risk. Heck, that could be the opportunity of a lifetime, as long as the business is still solid.
Okay, clash number 2. How do markets actually work? MCT believes the market is instantaneously efficient. Like news drops and boom, the price reflects it in a nanosecond. They'd say this means you can't beat the market consistently. Keyword, consistently. But the value investor says, hold on a second. They agree the market tends to be efficient, eventually, but it's a slow, sloppy process. And in that sloppiness, you can find opportunities to earn great returns persistently. See the difference? Not all the time, but on average, over the long run. That little word change is everything.
And the final big clash, who are the investors? Who's actually playing this game? MCT simplifies everything and basically assumes there's just one type of investor, this sort of robotic, monolithic entity whose only goal is to get the best risk-adjusted return. But value investing looks around and sees a wild, diverse ecosystem. You've got people trying to buy whole companies, retirees who just need cash income, corporate raiders, insiders, all of them playing with different rules and different goals. And that's what creates the mispricings value investors love to find.
Okay, that's a lot of theory, I get it. But where does the rubber meet the road? Where do you actually see this stuff in the real world? Well, it turns out there are huge parts of the financial universe that pretty much run entirely on value investing principles.
Welcome to the value investors playground. We're talking mergers and acquisitions, leveraged buyouts, distressed debt, all the stuff. In every single one of these situations, the public stock price, it's just a suggestion. It's the starting point for a negotiation. When one company wants to buy another, you better believe they're not just looking at the stock ticker. They're doing a deep dive into the business value. These are massive areas of finance that the MCT worldview kind of has to pretend don't exist, because they all prove that the public market price is definitely not the only price that matters.
So how do they do it? This is basically the value investor's 4-step playbook. And what's so wild about it is that it's the complete opposite of how most people think about investing. Just look at what's dead last on the list. Number 4, market considerations. Yeah, what the overall stock market is doing is practically an afterthought for them. They start with the business, they think about the risks to the business, they plan their exit, and then maybe they'll think about the market. It's totally upside down.
So at the end of the day, what we have here are two fundamentally different lenses, two totally different ways of looking at the exact same financial world.
One lens sees a clean world of efficient prices and neat statistical risk. The other lens sees a messy world of real businesses, human emotions, and hidden bargains. And this really just brings it all home. Modern capital theory, it's all about the behavior of markets, getting a good risk-adjusted return, and using diversification to protect yourself. Value investing, on the other hand, it's about deep knowledge of specific companies, buying them for less than they're worth, and believing that if you really know your stuff, you can concentrate your bets. Two totally different paths, two different philosophies, all happening in the same financial universe. So, that brings us right back to the beginning. Now that you've seen both sides of the argument, what do you think? Is the market a perfect pricing machine, getting it right all the time? Or is it more like a messy, inefficient field, where if you're patient and you know what you're looking for, you can discover some real treasures? The answer you land on, well, that's going to define your entire approach to investing. All right, let's get right into it. You know, we see it all the time. The headlines, the stock picks, the big buy and sell ratings from Wall Street experts. But have you ever really stopped to think about what's actually going on behind the scenes? What game are they really playing? Because it might not be the one you think it is. I mean, that's the multi-trillion-dollar question, isn't it? We have this picture in our heads that they're all these super sleuths digging deep to find the absolute best companies for the long haul. But what if that's not the whole picture? What if it's not even the main thing they're looking for? And that right there, that's the big blind spot we're going to dig into today. We're going to peel back the curtain on the conventional Wall Street playbook. And you're going to see that the things they care about, well, they're often the exact opposite of what someone who actually owns a business would focus on. So, here's the game plan. We're going to look at the Wall Street playbook, see why it's all about short-term wins, and point out the massive blind spots that come with it. Then, we'll flip the script and look at a totally different mindset, thinking like an owner. And of course, we'll wrap up with what all this means for you. All right, so first up, the Wall Street playbook. To get what's going on, you got to know who the players are. Think of it like this. The financial world is basically split into two big teams, and the way they work together, well, that's the key to the whole thing. So on one side of the street, you've got the sell side. These are the folks you hear about, the research analysts churning out reports, putting those big buy or sell ratings on stocks. And on the other side, you've got the buy side. These are the money managers, the people at the big funds who take those reports and actually, buy and sell stocks with billions of dollars. And trust me, it's a very specific dance they do together. Let's look at a real-world example. Back in '98, you had Toyota Industries. Now, this thing was a classic safe and cheap stock. It was basically a backdoor way to own Toyota Motor for way less than it was worth. A no-brainer, right? Wrong. The analysts, they couldn't have cared less about the deep value. What they wanted to see was a catalyst. They needed some kind of spark, a merger, a big earnings surprise, something that was going to make that stock price jump like now. And it's the same story with Kmart's debt a few years earlier. The big question on Wall Street wasn't, hey, is this debt a good long-term investment? Is there real value here? Nope. The only question they were asking was, are they going to file for bankruptcy? And if they do, will the price tank in the next month? See the pattern? It's all about guessing the next price tick, not judging the actual long-term worth of the asset. So this brings us to our next section, chasing short-term wins. You see, this obsession with catalysts and what the price is going to do tomorrow, it's not just a quirk. It comes from a really specific philosophy, a worldview they call the going concern approach. It sounds kind of technical, the strict going concern approach, but the idea is actually super simple. It basically says that a company's worth is almost entirely about its future earnings. What's it going to make next quarter and the quarter after that? Everything revolves around that income statement and predicting those profit numbers. Everything else, just noise. So if you were to look at a typical analyst's checklist, this is what you'd see. It's all about guessing the future. What are the earnings per share or EPS going to be? Is there some big news, a catalyst on the horizon? How's its PE ratio looking next to the competition? Is everyone else on Wall Street talking about it? But think about what's missing here. There's nothing about the company's actual stuff, its assets. Nothing about whether it's financially strong enough to survive a downturn. It's just not part of the equation. And this quote, man, it just says it all. Low price alone is not a sufficient condition for making a securities purchase. Let that sink in for a second. That means finding a dollar bill selling for 50 cents isn't good enough for them. There has to be a story, a catalyst, a reason to think other people are going to start buying it right now. Okay, so that's the playbook. But here's the thing.
it's incredibly fragile. And that brings us to the next part, the conventional analyst's blind spots. Because when you're this focused on predicting the immediate future, you end up missing some really, really big things. Okay, flaw number one, and it's a big one, forecasting the future is ridiculously hard. I mean, think about it. For most companies, trying to predict their earnings a year or two out is basically a guessing game. And those predictions, they are often wrong by a mile. So if your whole strategy is built on a foundation of sand, what happens when the tide comes in? You've got nothing to hold on to, no safety net. Which leads to this great metaphor. It's like trying to fight for the heavyweight championship, but you've decided to tie one hand behind your back before you even step in the ring. By focusing only on earnings, the income statement, and completely ignoring the balance sheet, they're literally choosing to ignore half of the company's story. And this is where things get truly wild. Flaw number two, ignoring the balance sheet. Now, you and I would probably think that a company with a mountain of cash and very little debt is a good thing, right? It's safe. But to the conventional analyst, that's actually a bad thing. They see it as management not being aggressive enough, not juicing the numbers for a higher return on equity. An owner sees a strong balance sheet and thinks, yes, staying power, the ability to survive a crisis and buy up my competitors when they're in trouble. Two totally different worlds. And let's talk about how easy it is to game their favorite number, earnings per share. Look at this merger illusion. You've got one company buying another. You match the numbers together, issue some new stock, and poof, your earnings per share jumps 20%. Did the business actually get 20% better? Nope, not at all. It's just math. It's financial engineering. But if you're an analyst whose bonus depends on finding EPS growth, this looks like pure genius. And the blind spots just keep coming. You've got this obsession with the short term. There's no safety net for when the market goes haywire. They end up trusting a smooth-talking CEO more than the actual financial statements. And let's not forget the internal pressures. The investment banking side of the firm really wants them to like certain stocks. It's just a fundamentally shaky way to operate. So if that's the flawed playbook, what's the right way to do it? Well, this brings us to a much more robust alternative, thinking like an owner. It's a simple idea, but it changes everything. It's about a complete shift in your mindset, from being a stock picker to being a business owner. And this table really breaks down the two different games being played. The analyst, they're playing for next quarter. Their entire job is to predict the stock price, and their tools are things like PE ratios and EPS forecasts. But the owner is playing for the next decade. They're not trying to guess the stock price. They're trying to build long-term wealth. And their go-to tools are the balance sheet and mapping out their exit strategies. Think about it. When a real business person, a control buyer, is looking to buy an entire company, they don't ask about next quarter's earnings. They ask three simple, powerful questions. Number one, how am I going to finance this whole deal? Number two, what's the real long-term outlook here? And number three, what are my different ways to get my money out down the road? See, it's a totally different set of priorities. And here's the kicker, the ultimate conflict of interest. A smart owner's goal is to build wealth in the most efficient way possible. And you know what that often means? Minimizing taxes. But minimizing taxes can make your reported earnings, the number the analyst lives and dies by, look lower. So a brilliant move for an owner can look like a terrible quarter to an analyst. Their goals just aren't aligned at all. All right, let's bring this all home, what this means for you. We've torn down the Wall Street playbook. We've built up this alternative owner mindset. So what? What's the big lesson here for all of us? Well, after all this, the big point isn't that you should just plug your ears and ignore everything an analyst says. No, it's understanding why they're saying it. It's knowing what game they're playing. So now when you see that buy rating, you have a new lens. You can ask, okay, is this recommendation based on the analyst playbook of short-term earnings and catalysts, or is it based on the owner's playbook of long-term value and financial strength? And that's the question I want to leave you with. It's a simple but incredibly powerful filter. The next time you hear any stock tip, any piece of financial advice, just stop for a second and ask yourself that one question. Is this an analyst talking, or is this an owner talking? And trust me, the answer to that question will tell you just about everything you need to know. You've seen it happen, right? A company drops its earnings report and bam, the stock price either shoots for the moon or completely tanks. But what's really going on behind those numbers? Well, today, we're popping the hood on corporate financial reports to figure that out. I mean, every single quarter, the headlines are all about companies beating or missing their earnings. But what does that one little number, that earnings per share, actually tell us? Is it really a simple report card on how a company's doing, or is it just the first piece of a much, much bigger puzzle? Let's dive in.
So let's start by calling this what it is, the numbers game. And I call it a game because in a lot of ways, that's exactly what it's become. It's this high-stakes quarterly event where pretty much everyone, investors, analysts, the media, they're all scrambling to figure out who's winning. Now, these financial statements, they're all built using the same rule book. It's called GAAP, which stands for Generally Accepted Accounting Principles. You can just think of it as the official language of business. And while everybody agrees that these reports are super powerful, the real debate is about what they're actually for. And this is where things get really fascinating. It turns out there isn't just one way to read these reports. You can look at the exact same set of data through two completely different lenses and come to two totally different conclusions. So let's meet the two main players in this game. In one corner, you've got the predictor. They represent the conventional, mainstream way of thinking. And in the other corner, we have the detective, who takes a completely different approach, the fundamental finance approach. Okay, so what's the difference? Well, on one side, the conventional approach is all about short-term prediction. It's about using the numbers to guess what the stock price is going to do next. But on the other side, the fundamental approach uses those same numbers for long-term understanding, treating them like clues to figure out how the entire business really works. All right, let's take a closer look at that first team, the predictors. This is the view you see pretty much everywhere, on financial news, from most market analysts. Their main goal? Take a number, usually that famous EPS, and use it to predict what the market's going to do tomorrow or next week. So in their playbook, the income statement is king. Everything revolves around metrics like EPS and EBITDA. The focus is laser sharp on just what the numbers are. And for them, the ultimate test is how the market reacts. It's all based on this big assumption that the company is a going concern, meaning it's just going to keep chugging along as it is forever. This is the standard stuff you learn in most finance programs. But now, let's check out the other side. Let's talk about the detective. For the detective, the goal is to treat the whole financial report like a crime scene full of clues. The objective isn't to guess a stock price. It's to actually understand the business itself, its resources, its quality, its very DNA. You know, this approach, it totally flips the script. All of a sudden, the balance sheet, that list of what a company owns and what it owes, that becomes the star of the show. There's no single magic number to fixate on. Every little figure is a potential clue, and the focus shifts from what the numbers are to what they truly mean. This is how an activist investor thinks, or anyone who's actually trying to buy an entire company. They need to know exactly what they're getting into. So this clash of ideas, it brings us to a way deeper question. If one group sees a crystal ball for predicting stock prices, and another sees a complex puzzle, then what are we actually reading here? Are these financial reports the truth, or are they just a bunch of clues? Okay, here it is. And this might be a bit of a shock, but according to our source material, financial reports, even when they're prepared perfectly under GAAP rules, are not, and really they cannot be, a perfect reflection of economic truth. They're actually something else entirely. So why not? How can that be? Well, it's because the whole system is built on a few, let's call them unrealistic assumptions. For example, a company might have a factory on its books for the price it paid way back in 1980, not what that land is actually worth today. The rules also basically pretend inflation doesn't exist, and they use really rigid, inflexible definitions for assets. The system is designed for one thing, consistency, so you can compare Apple to Microsoft. It's not designed for perfect, real-world accuracy. So if these numbers aren't the truth, then what are they? Well, you can think of them as objective benchmarks. They're reliable, professionally audited, and disciplined starting points. They give everyone a common language and a toolkit that an analyst or detective can use to start their investigation and piece together their own version of the truth. Let me give you an analogy. The audited financial report, it isn't the finished house. No way. It's the pile of bricks, the lumber, and the blueprints. The analyst is the builder. It's their job to take all those raw materials and construct a true picture of the company's economic health.
So, how do we actually put this detective mindset into practice? Well, it's all about learning to read the entire map of the business instead of just reacting to those flashy road signs that say earnings beat or revenue missed. Okay, so here's the game plan. First, you start with the numbers themselves. That's your reliable, audited foundation. But then second, you have to question the assumptions baked into those numbers, like that historical cost thing we talked about. Third, you've got to do the real work to find what they actually mean for the business. And finally, you use the whole report as a roadmap to investigate the really important stuff. The intangibles, like the quality of the management team, the fine print in their contracts, or the health of their pension plan.
At the end of the day, it all comes down to this one critical shift in your perspective. For the detective, the focus is almost always on what the numbers mean, not just what the numbers are. It's about deep dive interpretation, not just shallow recitation.
So I'm going to leave you with this question. The next time an earnings report drops and everyone starts talking, will you be looking for a price target or will you be looking for the real story? Thanks for tuning in. Have you ever wondered what a public company is really up to? Beyond the slick press releases and the perfectly polished interviews with the CEO. Well, today we're grabbing our magnifying glass and putting on our detective hats. We're going to dive into how you can investigate a company by following the one thing that almost never lies, the paper trail.
So that's the big question, isn't it? For anyone who's an investor, an analyst, or really just anyone who's curious, with all the noise and all the hype out there, how do you slice through it all? How do you figure out what's really going on inside a business?
And the answer, believe it or not, is surprisingly old school, but it is incredibly powerful. And this isn't just some clever phrase. We are talking about a real physical trail of documents that can lead you straight to a much deeper, much more honest understanding of a company's true story. Okay, so every good investigation needs a case file, and this is ours. First, we're going to lay out the mission. Following the paper trail. Then we're going to crack open the evidence locker to see what we're working with. After that, we'll get into the fun stuff, decoding the clues. We also have to cover what to do when the trail goes cold. And finally, we'll deliver the investigator's verdict. Let's get started.
First things first, following the paper trail. Our mission here is to totally shift our mindset. We are not trying to predict the future. We're not looking for stock tips. Our goal is to get a deep, genuine understanding of the business right now.
Look, you can use these company documents in two totally different ways. On one hand, you've got traders trying to predict short-term stock moves. For them, speed is everything. Every single millisecond counts. But that's not us. We're on a different mission. Our goal is to truly understand the business, how it works, what its values are, where it's headed long-term. And for that kind of deep work, the completeness of the information is way, way more important than how fast you get it.
So what exactly is this paper trail we keep talking about? Well, it's not just a random pile of papers. Specifically in the US, it refers to this really unique system of comprehensive and, this is the key part, reliable written documents that public companies are required by law to file with the Securities and Exchange Commission, the SEC. Honestly, you can think of it as the master key that lets you look inside any public company you want. Okay, mission accepted. Now it's time to pop the lock and swing open the door to the evidence locker. Let's take a look at the kinds of clues we have to work with. Inside, you're going to find that the evidence pretty much falls into two big buckets. Over here, you have what we'll call freewheeling disclosures. This is the stuff like the CEO's annual letter, the press releases, the conference calls. This is where management gets to tell you their story their way. It shows you their style, their opinions, and let's be honest, it shows you what they want you to believe. But then over here, you've got the heavy stuff, the stereotypical SEC filings. These are the documents that the lawyers prepare, following super strict forms to make sure they're following the law and, maybe most importantly, to avoid getting sued. So this is your basic investigator's toolkit. The Form 10K, that's the big one, the official annual deep dive into the business. The 10Q is your quarterly checkup. The Form 8K, think of that as the breaking news alert for big stuff that happens unexpectedly, like a CEO quitting. The proxy statement is where you find out who's in charge and how much they're getting paid. And a prospectus comes out when a company wants to raise money by selling more stock. These documents right here, they're the foundation of any serious investigation.
But why should we trust any of this? Well, because of this right here, Rule 10b-5. This is the great anti-fraud rule from way back in 1934, and it's what gives this whole system its teeth. It says in plain English that you can't lie about something important, a material fact.
And you can't leave out something important if that makes the rest of what you're saying misleading. This rule is the entire reason the paper trail is so reliable. And beyond the actual law, there's a really powerful human element at play. The people who actually put these documents together, the lawyers, the accountants, the outside auditors, these are all professionals. They are not about to risk their licenses, their careers, and their entire professional reputations just to help some company fudge the numbers. Their own skin is in the game, and that's one of the best guarantees of truthfulness you can get.
All right, we've collected our evidence from the locker. Now comes the best part, decoding the clues. What can this stack of paper actually tell us about how a company really works?
By following this trail, you can build a surprisingly complete picture. First, you can get a real sense of the company's financial health from its statements. Next, you can uncover hidden obligations that are buried deep in the footnotes, things like huge pension debts or potential lawsuits. You can even start to judge the character of the management team by reading about their pay, any deals they're doing on the side, or legal troubles they're in. And all of this helps you do the most important thing, spot the really bad investments and stay far, far away.
Let's pull a real case file from the archives to see how this works. We're going back to 1971, and the company is Shenley Industries. The clue we're hunting for here is all about management's character.
So, digging into that year's proxy statement laid the whole story bare. The company that controlled Shenley was basically forcing out the smaller minority shareholders. And the price they were offering? It was a terrible deal, just grossly unfair. Now, that single document was like a giant flashing red light. It told you everything you needed to know. This was a management team that had zero respect for outside investors. So the verdict? Crystal clear. You would never, ever want to be a minority partner with that team, not in that company, not in any company.
Now, for as amazing as the paper trail is, it's not a magic 8-ball. It's so important to understand what it can't tell you. So let's talk about those times when the trail just goes cold. The biggest limit really comes down to this difference between hard and soft information. The paper trail is a goldmine for hard info. Audited financial numbers, legal contracts, historical data. Stuff that's factual and you can verify. What you absolutely will not find is soft information. You're not going to get the company's internal sales forecasts, you won't see their private budgets, and you won't find independent appraisals of what all their assets are worth. The system is actually designed that way on purpose, to keep companies from using subjective, forward-looking statements to pump up their stock. And the list of missing clues goes on and on. You're not going to read about a huge merger that fell apart at the last minute. You won't get to see their secret marketing plans or detailed engineering studies. You're definitely not going to find out how their costs stack up against their biggest rival. And you certainly won't find a memo detailing a nasty, long-running feud between two top executives. That kind of stuff just never makes it into the public record.
Let me give you another perfect example of this. Let's open the case file on Tishman Realty from 1976. The company was liquidating, which means it was selling off all of its properties. But there was a giant problem for investors. The public filings didn't include any real estate appraisals. So that one critical piece of soft information you needed, what are these buildings actually worth, it just wasn't there. An outside investor was completely flying blind. It was impossible to know if the deal was good or bad. The trail went totally cold. So we've examined the evidence, we've seen the strengths, we've seen the weaknesses. Where does that leave us? It's time for the investigator's final verdict on this whole thing.
The rigid, standardized format of all these SEC documents, it's really a double-edged sword. The huge advantage is that once you get the hang of it, you can become incredibly efficient. A practiced eye knows exactly where to look for certain clues and can skim through mountains of information really fast. But here's the disadvantage. Real life is messy, and it doesn't always fit neatly into a form. Sometimes that rigid structure just fails to capture what's really going on, or can even misrepresent what's actually important about a business. So what's the final verdict? It's this. The paper trail is an absolute godsend. There's no other way to put it. It is the essential, non-negotiable starting point for any serious analysis of a company. But, and this is the big but, you have to remember, it is not a crystal ball. It gives you an amazing map of the past and the present, but it cannot predict the future. At the end of the day, the paper trail gives you the facts. It gives you the evidence. It has what you need to start forming your own intelligent judgment. The only question left is, are you ready to start your investigation? Taking over a public company, it's not just some simple financial transaction. It's way more like a high-stakes game of chess. There's a whole playbook full of complex rules and strategic gambits that decide who wins and who loses control.
And trust me, what you've seen in the movies, the real thing is so much more interesting. So let's open up that playbook and see how these corporate battles are really fought. So here's our game plan. We're going to start with the single most important distinction that shapes every move: voluntary versus mandatory. Then we'll dive into the three main ways you can take control. First, the old school cash purchase. Second, the really clever move of using securities. And third, a super dramatic path that doesn't even involve buying shares. And then we'll wrap it all up by looking at how a company makes that final strategic call. Okay, so before we get into any of the specific tactics, there is one single concept you have to understand. It governs every single move in this game. Every takeover attempt is either voluntary or it's mandatory. Getting this difference is the key to understanding, well, everything else we're about to talk about. So what does that actually mean? Well, think of a voluntary path like an invitation to a party. The acquirer sends out the invite, and every single shareholder gets to look at it and decide for themselves, do I want to go to this party? Do I sell my shares? But a mandatory path, that's not an invitation. That's more like a law being passed. If enough shareholders vote yes on the deal, that decision is suddenly binding on everybody, even the people who voted no. And that distinction, it is absolutely crucial. All right, let's dive into the first and, the most direct path in the playbook, just using cold, hard cash to buy up a company's shares. This is the classic way to do it, but as you're about to see, there are a few very different ways you can actually use that cash. So an acquirer really has four main tools in their cash toolbox. They can just start buying shares on the open stock market, slowly and quietly, or they can try to negotiate a private deal for a massive chunk of stock. They can launch a big public tender offer, which is a direct pitch to every shareholder. Or they can use the company's own voting system, its proxy machinery, to force a cash merger. Now, those first three, those are all voluntary invitations. But that last one, the merger, that one's mandatory. This table really lays out all the strategic thinking. Just look at the speed column for a second. Buying on the open market, that's slow, could take forever. But a private deal can be done in weeks, sometimes even days. Now slide over to the key hurdle column. With that private deal, you gotta find someone willing to sell a huge block of stock. A tender offer is also pretty quick, but you have to pay a nice premium and deal with a bunch of SEC rules. And then there's the merger. It guarantees you get 100% of the company, but look at the speed. It's the slowest of them all because you have to go through a whole shareholder vote. See? Every single choice is a trade-off between speed, cost, and how certain you are of the outcome. So, of all these cash methods, let's zoom in on the most famous one, the cash tender offer. This is basically a big public invitation to all shareholders saying, hey, I'll buy your stock for this price, which is usually higher than the market price, but only for the next few weeks. It's a direct, really powerful appeal, and it is all about moving fast and making an offer that's just too good for people to pass up. Now, this whole process is super regulated, and that's mainly because of a law called the Williams Act. The whole point of that law was to stop these surprise Saturday night special takeovers, where a company could be ambushed over a weekend. That's why the bidder has to file all this public paperwork with the SEC, spelling out who they are, where the money's coming from, and what they plan to do. The offer has to stay open for at least 20 business days, which gives shareholders some breathing room to actually think about it. It's designed to be a very structured, very transparent process. Okay, but here's where it gets interesting. We've been calling the tender offer voluntary, right? Every shareholder makes their own choice. But what happens when the pressure to sell gets so intense that it doesn't really feel like you have a choice at all? This is where the whole thing can get pretty coercive. See, if an acquirer gets enough shares, enough to drop the number of shareholders below 300, they can threaten to go dark. And that means delisting the company from the stock exchange. Now, if you're a shareholder who didn't sell, your stock suddenly becomes completely illiquid. There's no public market for you to sell it on anymore. The psychological pressure of being stranded in a private company is just huge, and it often forces even the most reluctant shareholders to just give in and tender their shares. Okay, so up until now, we've only been talking about cash. But what if an acquirer doesn't want to, or maybe can't, spend billions and billions of dollars in cash? Well, that brings us to path number 2. Using the acquirer's own stocks and bonds as the currency to buy the company. And this quote right here just brilliantly captures how powerful this move is. Instead of paying cash, the acquiring company offers its own shares. So what's really happening? The target company's shareholders are just swapping their ownership in the old company for ownership in the new, bigger, combined company. They're basically financing their own takeover. It is a seriously clever way to get a massive deal done without having to come up with a mountain of cash. And just like with cash deals, you can do this voluntarily or through a mandatory merger. A voluntary exchange offer, well, it never guarantees you'll get 100% of the shares. But a mandatory merger, once that vote passes, you get everything. So what's the catch? The legal paperwork is just a nightmare, especially for the mandatory route. The acquirer has to file something called an S-4 registration statement with the SEC. You can think of it as two absolute monster documents, a prospectus for the new stock and a proxy statement for the vote, all fused into one. It is one of the most complex and expensive filings in all of corporate law. All right, let's move on to our third and final path. And honestly, this is where you see the most corporate drama. How can you possibly gain control of a company without buying a single additional share? Simple. You launch a proxy fight. Yeah, this quote pretty much says it all. When a takeover turns hostile, when the target company's management is fighting back tooth and nail, the ultimate battleground is almost always a proxy fight. This is where an activist investor or a hostile acquirer decides to just bypass management entirely and take their case directly to the real owners of the company, the shareholders.
So what exactly is a proxy fight? Well, it's pretty much a corporate election campaign. The challenger, the outsider, tries to convince shareholders to give them their proxy, which is just their right to vote. The whole goal is to get enough of those votes to elect a brand new board of directors, who will then, of course, approve the outsider's plan. You're not buying control with money. You're winning it at the corporate ballot box.
But, winning hearts and minds isn't exactly cheap. Launching a serious proxy fight is a massive, massive financial commitment. You're paying for teams of lawyers, sending out mailers, hiring firms to call up shareholders, not to mention PR campaigns. All in all, you are easily looking at costs deep into the seven figures. And that's just for the chance to get a vote.
And the thing is, the playing field is heavily, heavily tilted. The attacker has to pay all those millions of dollars out of their own pocket. But the current management, they get to use the company's money, the shareholders' own money, to pay for their defense. They also control all the timing of the meetings and the entire official voting process. So to win, that outsider needs an incredibly compelling argument, which usually boils down to one simple, powerful promise. Vote for me, and I will make your stock price go up. Okay, so we've walked through all the different paths now, buying with cash, exchanging securities, and launching proxy fights. So now let's just pull it all together and look at this whole thing from the acquirer's point of view as they're trying to make that final strategic choice.
This is basically the ultimate cheat sheet for the whole playbook. Look at the cash tender offer. Its biggest advantage is pure speed, but the disadvantage is you have to pay a pretty penny for it. Now, the mandatory merger. The huge advantage there is you're 100% certain you get control, but the downside is it's the slowest, most regulated way to do things. And finally, the proxy fight. The incredible advantage is you don't actually have to buy the company, but it is wildly expensive and totally uncertain if you'll win. Each one is the best tool for a very different job. So the most important takeaway here is this. There's no single best way to do this. Every single choice in the corporate takeover playbook is a calculated trade-off. What an acquirer ends up choosing depends completely on their goals. Are they all about speed? Or is certainty of control the most important thing? Or is it all about cost? The answers to those questions are what determine which play they're going to run.
And that leaves us with one last really fascinating question to chew on. When one of these mandatory mergers happens, a majority vote forces every single shareholder to sell their stock, whether they want to or not. So, is that just corporate democracy in action, the majority rules? Or is it actually a coercive power play that just tramples all over the rights of the individual investor? The answer to that question really gets to the very heart of what corporate power and shareholder rights are all about. All right, welcome. Today, we are diving into an investment strategy that comes straight from the playbook of some of the world's sharpest dealmakers. We're going to learn how to spot the hidden value in the market, the stuff that most people completely miss. So let's get right into it. So let's just start with a really big question. One that kind of challenges everything we think we know about the stock market. What if that number you see flashing on your screen, that stock price, what if that's not the whole story? What if it's not even the most important number? And that brings us to our first big idea, and it's something I like to call the dealmaker's secret. For any stock out there, there isn't just one price, there are actually two. This is really the key to the whole thing. Corporate insiders, activists, high-level dealmakers, they see the financial world through a completely different lens. While most of us just see one market for a company's stock, they see two totally separate marketplaces, and each one has its own rules and its own way of defining value. And this breaks it down perfectly. Over on the left, you've got the OPMI market. That's where you and I and most people live. We're buying and selling shares based on public perception, quarterly earnings reports, what the analysts are saying. But then, on the right, you have the control market. Now, this is a whole different ballgame. This is where entire companies get bought and sold. And here, the price isn't about perception. It's about the hard, intrinsic value of the business itself, its assets, its cash flow, what it's truly worth. So, what in the world is an OPMI? Well, it stands for an outside passive minority investor. And basically, that's most of us. If you buy and sell stocks on an app or through a broker, that's you. You're a part owner of the company, sure, but you're a passive one. You don't have any direct say in how the company is run. And that distinction, well, it's the foundation for this whole strategy. So, because you have these two different markets, it creates something we can call the great valuation divide. And for a smart investor, this gap isn't a problem at all. It is the opportunity. And you can see that gap right here. The OPMI market, the public one, might say a stock is worth $65. But in the control market, someone looking to buy the entire company might value it at $100 a share. That difference, that's the valuation gap. And that's exactly where the potential for profit is hiding. And this isn't just some random market quirk. There's actually a name for it. The source material calls it a long-term arbitrage opportunity. It's the chance to profit from that difference between two distinct valuations for the exact same asset. Okay, so how do you actually find these companies? Well, it is not about guesswork. The pros use a very methodical approach, a checklist, really, for spotting these potentially undervalued gems. It all boils down to these three things. First, you have to look at the fundamental quality of the business itself. Then, you look at the terms of the stock or bond you're buying. And finally, you look at the price. Is it cheap? Is it trading at a discount? If you can get a yes on all three of these, you might have just found a winner. Let's drill down a bit on that first one, quality, because it's so important. A quality company, according to our source, is one you can actually wrap your head around. It's got a strong balance sheet, not a lot of debt, and it's spitting out real cash from its operations. And crucially, it's run by people who are competent and honest. It's all about substance, not hype. And that brings us to that third step, price. See, it's not enough for a company to be good. It has to be cheap. This is what's called the margin of safety. Dealmakers are looking to buy into these quality businesses at a discount of at least 20% from what they calculate its true control value to be. Okay, but here's where it gets really, really interesting. Finding a high-quality company that's undervalued, that's a great start. But the real pros, they take it one step further. They look for what they call doable deals. Just think about it for a second. A company's stock can be cheap for years and just stay cheap if nothing ever happens to change things. So the really critical question an activist investor asks is this: is there a way to force the market to finally see the value that we see? Is this a doable deal? And this is where activists start hunting for a catalyst. The source material calls these resource conversion events, and they are basically major corporate actions designed to slam that valuation gap shut, forcing the market to finally wake up and recognize the company's true worth. So, what kind of events are we talking about here? Well, first up, you've got mergers and acquisitions. When a company gets bought out, the buyer almost always pays a price that's much closer to that control value, which means a huge premium for the shareholders. Next up, corporate contests for control. Think proxy fights, activist campaigns. This is where an outsider tries to take over or at least influence the company to make changes that will unlock all that hidden value for everybody. And finally, we have leveraged buyouts, or LBOs. This is when a private equity firm, or maybe even the company's own management, decides to take the company private. They buy up all the public shares, and again, they do it at a price that reflects that true control value. So, okay, let's bring this all home. We've got two markets, a valuation gap, and catalysts that can close that gap. What in the world does all this mean for you, the outside passive minority investor? You know, this quote from Martin J. Whitman, whose work this whole explainer is based on, it just perfectly captures the entire philosophy. Investing in good companies at low prices gives you two critical things: comfort, and above-average returns. Let's break that down because it's huge. The comfort part? That comes from minimizing your risk. You can sleep at night because you bought a quality business with a strong balance sheet at a massive discount. That's your safety net. And the above-average returns? Well, that's just simple math. You bought $1 worth of assets for 80 cents, or maybe even less. When the market finally recognizes that, your returns get a natural boost. And here it is, maybe the most important takeaway of all. You do not have to launch a takeover or become an activist investor to use this knowledge. Just understanding that this valuation gap exists and learning how to spot it gives you a massive analytical edge over almost everyone else in the market. So that leaves us with a final challenge. Using this new framework, this new way of seeing things, take a look at the market. Which companies out there, the well-managed, financially strong ones, are trading at a deep discount to their true worth? Which ones are hiding value in plain sight? That's the question every savvy investor should be asking. You ever see a huge company in the news teetering on the brink of disaster and wonder what really happens next? We all see the scary headlines about bankruptcy, but that's almost never the end of the story. In fact, it's usually just the beginning of a complex, high-stakes game. Today, we're going to pull back that curtain and look at the world of corporate restructuring. So yeah, bankruptcy. What does that word even mean to you? For most of us, it sounds final, lights out, game over. But what if I told you that for a very specific type of investor, bankruptcy isn't the end of the game at all? It's the starting pistol. And that brings us to the fascinating world of distress investing. See, while most investors are trying to guess if a stock is going to go up or down tomorrow, distress investors are playing a totally different game. They jump in after a company defaults on its debt, and they're focused on much bigger questions. What happens now? Who gets their money back? Who gets completely wiped out? And what's this company even going to look like when the dust settles? So here's our game plan for today. We're going to break down what this is all about. We'll start with the incredible power creditors have, then we'll walk through the essential rules of the game. After that, we'll check out the different plays a company can use to survive, look at how they can sell off assets or get a cash bailout, and finally, we'll tie it all together.
Okay, let's dive right in with the most important principle of them all. This is the one thing that shapes every single deal, every negotiation, every courtroom battle. It's the first truth, the absolute power of the creditor.
So here it is, truth number one. It's incredibly simple, but it is everything. If a company owes you money, they have to pay you, period. Now, the key here is the phrase, outside of a bankruptcy court proceeding. As long as the lawyers aren't involved in a formal Chapter 11, nobody can force a creditor to take less money than they're owed or accept a later payment unless that creditor agrees. That right is basically sacred. And don't just take my word for it. This isn't some unwritten rule. It's hammered directly into U.S. law. The Trust Indenture Act of 1939 makes it absolutely clear. This one sentence is a legal sledgehammer. It gives creditors enormous leverage. It means a company can't just force its bondholders to take a haircut, accept less than 100 cents on the dollar, unless they're willing to dive into the messy, chaotic world of bankruptcy court. And this plays out in some amazing ways in the real world. Let's take a look at a classic case, GMAC, right in the middle of the 2008 financial crisis. Their bonds were getting absolutely hammered, trading for just 62 cents on the dollar. That meant the yield to maturity was a mind-blowing 53%. The market was screaming that this company was toast. But the smart money, the investors who really understood truth number one, they knew GMAC would do anything to avoid bankruptcy. And that meant, legally, they had to pay these bonds in full. So what happened? GMAC got a government bailout, the bonds were paid, and the investors who bet on the rule book instead of the panic made an absolute fortune. All right, so that's the first and most fundamental truth. That's the foundation for everything else. Now let's get into the other four truths that really define the rules of this complex game. Truth number two is this. Chapter 11 is the ghost at every negotiating table. It's always there, lurking in the background. Even when a company is trying to cut a deal outside of court, everyone in the room knows what would probably happen if they did go to court. So the potential outcome of a bankruptcy case creates the invisible walls for any private deal. Third, you have to completely rethink what value means in these situations. It's not about future profits or dividends like you'd think about with a healthy stock. It's all about the potential for a cash bailout. That could mean the company finds the money to pay you. It could mean you sell your position to another investor. But crucially, it can also come from raw power.
If you own enough of the company's debt, you get a seat at the table to help decide what happens next. And that control is its own form of value.
Now, if you read academic papers on this stuff, you'll often see this number pop up, 3.1%. They say that's the direct cost of bankruptcy, paying the lawyers and the bankers. Sounds pretty manageable, right?
Well, the fourth truth is that that number is pretty much garbage. It's incredibly misleading. And here's why. All those fees for the bankers and lawyers are called administrative expenses. That means they get paid first, in cash, before the people who actually lent the company money in the first place see a single dime. So what really matters isn't the percentage of some old imaginary book value, it's the percentage of the actual cash left that gets eaten up by fees. And that number can be enormous. And that brings us to the fifth and final truth. And this one is a massive legal shift that most people have no idea about. For a healthy company, the board of directors has one job: look out for the shareholders. But the second a company gets into what's called the zone of insolvency, everything flips on its head. That legal duty switches from the shareholders to the creditors. The entire game has just fundamentally changed.
So now that we know the 5 truths, what can a company in trouble actually do about it? Well, they have a playbook, and there are really 3 main paths they can take to try to reorganize and survive. Okay, the first 2 options are polar opposites. A company can try a voluntary exchange. They basically just ask their creditors nicely to swap their old debt for new debt that's easier to pay off. It can be fast, and management keeps control. The problem, remember truth number 1, any single creditor can just say, nope. This is the famous holdout problem. Why would I agree to take less if I know you legally owe me the full amount? So the alternative is a conventional Chapter 11, where you go to court and a judge forces a plan on everybody. But that is slow, unbelievably expensive, and management loses a ton of control. This huge contrast leads us to the third and often smartest path, the prepackaged bankruptcy, or prepack for short. This is where the company negotiates the entire plan with its major creditors before they ever step foot in a courtroom. Once everyone's on board, they file for Chapter 11 just to get the court's official stamp of approval. That makes the plan legally binding on any holdouts. You get the speed of a private deal with the power of a bankruptcy court. It's the best of both worlds.
But just changing the terms of your debt isn't the only way out. There are 2 other major rescue strategies a company can use: selling off the good parts of the business or getting a massive injection of new cash.
A really fascinating tool here is what's known as a Section 363 sale. Think of it as a court-supervised auction. First, they get a stalking horse bidder to make an initial offer, which sets the floor price. Then, the court opens it up to everyone else to see if they can get a better price. But here's the real magic for the buyer. They get to purchase the assets free and clear of all the old company's debts and problems. It's a totally clean slate. A perfect example of this in action was the telecom giant Nortel. After they filed for bankruptcy, they used a 363 sale to sell off their really valuable wireless assets. Nokia Siemens came in as the stalking horse with an opening bid of $650 million. That set the stage for competitive auction that ended up getting a much better price for Nortel's creditors. And the final rescue method is just a straight-up capital infusion. This is when the cavalry arrives, a powerful competitor, a super-rich investor, or even the government, and they step in with a mountain of cash to stabilize the company. This happens when the company is seen as too big to fail or has long-term value. We saw this constantly during the 2008 crisis, right? JP Morgan buying Bear Stearns, the government bailouts of Fannie Mae and AIG, Warren Buffett investing in Goldman Sachs. It was happening everywhere. The government's TARP program is the perfect case study. They didn't just hand over cash and hope for the best. They got securities in return. Most of it was in what's called preferred stock, which basically paid the government a steady dividend, kind of like a loan. But the really clever part was the warrants. These gave the government the right to buy the company's common stock later at a fixed low price. That meant if the company recovered and its stock shot up, the taxpayers got to share in the upside. Okay, so we've walked through the rules, the playbook, and all the different kinds of rescues. Let's zoom out. What's the big picture here? What should you really take away from all this? I think it's this. Corporate restructuring isn't a death sentence. It's really a kind of rebirth, but it's a messy, expensive, and often brutal process. It's a strategic game played by incredibly sophisticated investors, lawyers, and managers, and every single move is governed by those 5 fundamental truths we've covered today. And all of this leaves us with one final critical question to think about. In all of these high-stakes rescues, whether it's a pre-pack, an asset sale, or a government bailout, when a company is finally saved, who are the real winners? Who walks away with the rewards? And who are the ones, the employees, the original shareholders, the taxpayers, who ultimately end up paying the price?
We've all seen it happen. A huge company, a pillar of the economy, suddenly teeters on the edge of collapse. And just as suddenly, the government steps in. But what is its real role in all of this? It's a world filled with high-stakes decisions, super confusing jargon, and, well, consequences that impact every single one of us. So let's dive in and unpack it.
So what actually happens when one of these titans of industry starts to fall? I mean, this is the kind of question that keeps policymakers, investors, and yeah, even us up at night. When a company that feels absolutely essential to our economy starts to crumble, what's the right move? Who's supposed to step in? And maybe most importantly, how do they do it without, making a bad situation a total catastrophe?
Okay, so when a company is in serious trouble, you've basically got a toolkit with three main options. First, you can try to reorganize its finances. Think of it like hitting a giant reset button. Second, you could liquidate it, basically sell off all its parts and assets for cash. Or third, and this is where things get really interesting and controversial, you can infuse it with new money, a fresh injection of capital to try and keep it afloat.
All right, so here's our game plan for this explainer. We're going to start by untangling some of that crisis language. What's a bailout versus a capital infusion? Then we'll tackle that huge myth, too big to fail. After that, we'll look at the partnership that's always there between government and business. We'll also check out a pretty revolutionary shift in how these big reorganizations are handled and wrap things up with a really surprising argument for more regulation. Let's get started.
All right, first things first. Let's talk about the language of crisis in a word you have heard a million times: bailout. It's such a loaded term, right? But it turns out, a lot of the time, we might be using it all wrong. And the real distinction here, well, it's absolutely crucial.
So the core idea here is that just because the government injects capital into a company, it doesn't automatically mean it's a bailout in that negative throwaway money sense. The whole difference, the thing that changes everything, comes down to one simple question. Is there any expectation of getting that money back?
Think of a true bailout like this. It's a one-way street. It is money handed over with absolutely zero expectation of ever seeing it again. It's a pure loss, basically a grant to stop a much bigger disaster from happening. There's no upside for the one giving the money, none at all.
And when you put them side by side, the difference is pretty stark, right? A bailout, that's a guaranteed loss. But a capital infusion, now that's something different. That's an investment. Sure, it might be a risky one, but it's made with the full expectation of getting the money back. And hey, maybe even turning a profit for the government and the taxpayers, just like any other investor would want.
So what's the real problem here? The argument is that the big failure back in 2008 and 2009 wasn't the act of putting money in. It was the failure to demand something in return, a quid pro quo, something for something. Any private investor would have demanded major concessions, like forcing a company to restructure its bad loans. But the argument goes that the government just didn't play hardball. It didn't use the massive leverage it had.
Okay, so this whole discussion leads us straight to probably the most famous or maybe infamous phrase to come out of the financial crisis: too big to fail. But what if that entire concept is, well, just plain wrong?
Yeah, I know. Saying too big to fail is a phony concept is a pretty bold statement. I mean, the common wisdom, what we all hear, is that some companies are just so huge and so tangled up in the economy that if they go down, they take everyone else with them. But what if that's not the real problem? What if we've been looking at it all wrong?
Here's the reframing. The real issue isn't the size of the company. It's that our system didn't have a good way to manage its failure in a controlled, orderly way. See, an uncontrolled collapse is what's truly terrifying. It's chaotic, it's unpredictable, it's insanely expensive. And that's the nightmare scenario everyone is trying to avoid. So the problem wasn't the size of the company, it was the lack of a proper process.
Which brings us to a really fundamental idea about how our economy actually works. We tend to think of the government and the private sector as two separate things, right? Maybe even as opponents. But according to this analysis, that's a huge misunderstanding of what's really going on.
The reality is, they're more like partners, whether they like it or not. They're two sides of the same coin, completely linked. Government policies have a massive impact on what the private sector does, and vice versa. So when a crisis hits, just blaming one side or the other totally misses the point. They're both part of the problem, and they both have to be part of the solution.
So how exactly does the government steer what we think of as the invisible hand of the market? Well, it's definitely not a passive observer. It's actively guiding things with some incredibly powerful tools. Think about it. Tax policy creates huge incentives for businesses to do one thing and not another. Decisions about credit, who gets it and how, direct the flow of literally trillions of dollars. This is anything but a hands-off approach.
And this leads to a really challenging idea, one that goes against a lot of what we normally hear. We're always told about the dangers of moral hazard. You know, the idea that if you bail people out, they'll just keep taking reckless risks. But here's a thought. What if taking some of those risks is actually necessary for innovation and economic growth? The argument here is that maybe the real danger isn't moral hazard, it's just plain incompetence and everyone just following the herd off a cliff.
Okay, so if uncontrolled, chaotic failures are the real enemy, have we actually figured out a better way to do things? Well, it turns out that the year 2009 might have been a quiet but absolutely massive turning point for how we deal with these huge corporate collapses.
You have to understand, in the past, a major bankruptcy, like say General Motors, would have been an absolute nightmare. A totally uncontrolled process dragging on for years and costing billions. But in 2009, something different happened. The reorganizations of GM, Chrysler, and CIT set a brand new precedent. They showed that these massive, complicated proceedings could actually be controlled. They could be fast, and they could still preserve the rights of everyone involved.
Seriously, just let that number sink in. Less than 60 days. We're not talking about a small local business here. These were industrial and financial giants. To push them through a court-supervised reorganization in under 2 months was, well, it was basically unheard of. It was proof that a fast, controlled process for the biggest of the big wasn't just some academic theory. It could actually be done.
So where does all this leave us? What's the big lesson we're supposed to learn to prevent the next crisis? Well, the conclusion is probably not what you'd expect. It's not a call for less government. It's a case for smarter and much stricter regulation.
So after digging through all the failures, all the myths, the argument is that the path forward is actually pretty clear. The idea that comprehensive, strict regulation is the enemy of a healthy financial system is wrong. In fact, it's the total opposite. It's an absolute prerequisite for stability and long-term success.
And if you're looking for proof, look no further than an unlikely place, the mutual fund industry. I mean, this is one of the most ultra-strictly regulated corners of the entire financial world, thanks to a law from 1940. And what happened? That incredible strictness is precisely what created massive investor trust. And that trust? It fueled enormous success and growth. It's a fantastic, real-world example of how smart regulation doesn't kill an industry. It can be the very foundation it's built on.
All right, we have covered a ton of ground and hopefully challenged a few big common ideas. So let's do a quick rundown of the main takeaways here.
So what are the big things to remember? First, a capital infusion and a bailout are not the same thing. Second, that phrase, too big to fail, isn't really about size. It's about being too big for an uncontrolled reorganization. Third, government and the private sector are partners, period. Fourth, we now know that controlled, super-fast reorganizations of massive companies are actually possible. And finally, the big argument is that strict, intelligent regulation isn't the problem, it's the proposed path forward.
And all of this leaves us with one last really big question to chew on. The source material suggests that financial crises are pretty much inevitable, that markets are just naturally volatile. So if that's true, if another storm is always on the horizon, is getting regulation right our best and maybe even our only real tool to make sure the next one isn't a total catastrophe? Something to think about. Thanks so much for joining me for this explainer.
All right, let's dive into a really fascinating story. It's about the Hertz leveraged buyout, and it's basically the perfect case study for understanding how private equity firms can make just an insane amount of money. We're going to break down the exact playbook they used step by step. So right off the bat, you're hit with this paradox. On one side, you have Hertz, the actual company, which was, not doing so great. It was called a, quote, quite mediocre operation, and it was losing money in half the years we're looking at. But then on the other side, you have its new private equity owners who walked away with something like $7 billion in value. So yeah, how is that even possible? I mean, how can a company that's struggling so much generate that kind of wealth for its owners? The answer really gets to the core strategy behind a lot of these huge private equity deals.
To really get it, we've got to rewind the clock to December 2005. Ford Motor Company, they're looking to sell off their rental car business, Hertz. And that's when this powerful group of private equity firms spots a massive opportunity and decides to jump in and buy it. And that brings us to our first section, the LBO playbook. See, to understand how these firms made so much money, you first have to understand the powerful financial tool they used to buy Hertz in the first place. And that tool is called the leveraged buyout, or LBO. The whole idea is pretty brilliant, really. You're buying a company, but you're not actually using that much of your own cash. Instead, you borrow a ton of money, debt. And then the company you just bought, well, it becomes responsible for paying all that debt back. Now, the architects of this whole thing, they're called the sponsors. And in this case, it was a group of some of the heaviest hitters in private equity, Clayton, Dubilier and Rice, the Carlyle Group, and a fund from Merrill Lynch. These are the guys who put the whole deal together. So what was their strategy? Well, it was pretty simple, really, and had two main goals. First, pull as much cash out of the company and into their own pockets as fast as humanly possible. And second, while you're doing that, you've got to keep a firm grip on the company's decisions so you can make that cash extraction happen, and then eventually sell it all for a big profit. And this leads us to the real secret sauce behind their success. You see, it wasn't about them coming in and magically fixing the car rental business. No, it was about something else entirely. Their incredible, almost unbelievable ability to get their hands on huge piles of money. And this quote from our source material just says it all. The key wasn't that they were operational geniuses, it was that they were financial geniuses. These sponsors had the credibility and the know-how to borrow money on really, really good terms over and over again. But that brings up a pretty obvious question, right? If the company itself isn't doing so hot, how in the world do you convince banks to lend you billions of dollars? Lenders, they usually like to see strong, steady profits. Okay, so the official way a company measures its profit is called GAAP net income. GAAP stands for Generally Accepted Accounting Principles. It's the standard, and it includes all the costs of doing business, things like paying interest on your debt and also depreciation on your assets, which for a car rental company is a big deal. Now, if you look at Hertz official GAAP net income, oh boy, the picture is pretty bleak. The company lost over $1 billion in 2008 alone, and the losses just kept coming. Let's just say you don't take this chart to a bank when you're asking for a loan. So the sponsors just focused on a different number entirely, EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a way of looking at the company's cash flow that conveniently ignores a lot of the major expenses that GAAP net income has to include. And would you look at the difference? It's absolutely staggering. For the exact same years that Hertz was showing these huge losses under GAAP, its EBITDA was positive and massive. We're talking over $1 billion in 2008 and 2010. This tells a completely different and way more attractive story to the people with the money. So that was the key. That was the whole game. By selling the company's performance using these much healthier EBITDA numbers, the sponsors were able to make the case that Hertz was actually a great credit risk, and that unlocked the billions in loans they needed to make their strategy work. Okay, so now we know how they got access to all that money, so let's follow it. This next part is all about exactly how that cash got pulled out of Hertz and landed right in the sponsors' pockets. And they did not waste any time. The pace was just relentless. Just 6 months after buying the company, boom, they take out a new loan to pay themselves a dividend of almost $1 billion. Then they take the company public in an IPO and use some of that money for another dividend. After that, it was just systematic. They sold off their shares to the public in these huge chunks, cashing out again and again and again. And here's what it all adds up to, the grand total. In just a little over 6 years, the sponsors and their funds pulled out nearly $5 billion in cold, hard cash, either from Hertz itself or from selling its stock to the public. But what's truly mind-boggling is that even after taking out $5 billion, they still weren't done. At the end of 2012, they still owned more than a quarter of the company. And that stake, it was worth another $1.8 billion. The total value they generated for themselves was just immense. Part of their genius was also playing the game on Wall Street. Just look at the fees they paid to the banks, the underwriters, when they were selling stock. It was a much higher percentage than what a huge tech company like Facebook paid. By being generous with the bankers, they basically made sure that Wall Street would always be excited to pick up the phone and help them get access to more and more capital. So we've seen the playbook, and we've seen the incredible results for the sponsors. But what about everybody else? In this last part, let's take a look at the bigger picture. Who really wins in a deal like this? So first big question, did any of this actually help Hertz as a company? It's really hard to see how. You're loading a company up with debt just so you can pay dividends to the owners. That makes the company financially weaker, not stronger. The focus was so clearly on extraction, not on investment. Okay, second question, what about the economy as a whole? Well, the analysis here suggests this model isn't really a win for the broader economy. I mean, when the main goal is just to pull cash out of a business, that's capital that isn't being used to grow, to hire more people, or to innovate. It's just getting rerouted to the private equity sponsors. And that leads us to the final and maybe most important question. Are LBOs good for investors? Well, the thing is, it totally depends on which investor you are. If you were one of the people who bought Hertz stock from the sponsors on the public market, your results were kinda mixed. But if you were an investor in the private equity funds run by these incredibly skillful sponsors, the answer seems to be a resounding yes. Let me tell you a story that sounds like it's straight out of a Hollywood thriller. It's about a young, super aggressive upstart company that decides to target this sleepy old money giant, a company more than 10 times its size. On paper, it's impossible, but through a series of just brilliant, almost unbelievable financial moves, they pull it off. And get this, they do it without spending a single penny of their own money. This isn't fiction. This is the incredible true story of how Liasco captured the Reliance Insurance Company. Okay, so let's set the stage. Look at this matchup. In one corner, you've got Liasco. They're in the hot new computer leasing business, worth maybe $16 million. And in the other corner, Reliance Insurance, an old, established insurer with a net worth of $230 million. I mean, it's a total mismatch, right? But Liasco's founder, a guy still in his 20s, saw something nobody else did. He saw a weakness, not in their balance sheet, but in how the stock market was valuing them. And that was his way in. So, here's how we're going to break down exactly how this corporate heist went down. We're going to look at why Reliance was such a juicy target, the absolutely brilliant and free option Liasco created to get all the leverage, how they completely neutralized management, the mind-bending financing they used to pay for the whole thing, and of course, the deeply ironic twist at the very end of the story. All right, first up, David versus Goliath. So what was it about this quiet, conservative insurance company, a business that Wall Street basically thought was a total snooze fest, that made it the ultimate prize for a young shark like Liasco? Well, the answer is that Reliance was secretly sitting on a hidden treasure chest. Yeah, its stock price was low, but that's because the market was only looking at its boring insurance profits. Liasco, though, saw what everyone else was missing, these massive pools of extra cash. In the insurance world, they call it surplus. It's basically money the company didn't need to cover claims, which a new owner could just take out and use. And even better, Reliance owned a portfolio of stocks they bought ages ago that were now worth hundreds of millions more than what they were listed for on the books. For Liasco's founder, Saul Steinberg, this wasn't just another company. It was the key to building a financial empire. Now, the key, and I mean the key, to unlocking all this treasure was a funky old accounting rule that doesn't even exist anymore. It was called pooling of interests. See, normally, when you buy a company, you have to mark all its assets up to what they're worth today. But with pooling, Liasco could bring all of Reliance's assets onto its own books at their original, decades-old, super low cost. This little trick was the secret weapon for all the hotshot conglomerate companies back in the 1960s. And this just shows you how big the prize was. By using pooling, Liasco could take over Reliance and then immediately turn around and sell those stocks from the portfolio. And the difference between that low book value and the high market price, it would all flow straight to Liasco's bottom line as pure, instant profit. We're talking about a potential windfall of over $10 per share in pre-tax earnings. Now, for a company like Liasco that had never even earned $1 a share in its entire history, this was literally like finding a magic money machine. So let's keep going, because this is where the plot really thickens. Naturally, when Liasco first went to Reliance management and suggested a friendly takeover, they were pretty much told to get lost. But Steinberg and his team didn't back down. Instead, they pulled off one of the most clever strategic moves in takeover history.
They didn't fight management head-on. They just went around them.
See, Lisco spotted a huge weakness. The guys actually running Reliance day to day, they were dug in for sure, but they didn't really own much of the company, a measly 43,000 shares between them. The real power, it turned out, was held by two outside family groups who together controlled a decisive 14% chunk of the stock. And since these families weren't involved in running the company, Lisco figured, hey, maybe they'd be willing to sell.
So they came up with this absolute masterpiece of an agreement on July 23, 1968. Here's what they did. Liasco promised to buy that whole 14% block for cash at a great price. But, and you have to appreciate the genius of this, the deal was conditional. Liasco only had to buy the shares if their public takeover of the rest of the company actually succeeded. If their takeover failed for any reason, the deal was off, and Liasco owed nothing. It was, for all intents and purposes, a completely free option that gave them control over the Kingmaker block of stock. Zero risk.
Okay, so armed with this unlosable option, Lisco went back to talk to Reliance's management. But you can bet the conversation was very different this time. Lisco now had a metaphorical gun to their head, and they used that leverage to negotiate from a position of just incredible strength. And this move was checkmate. In a new agreement on August 1st, Reliance management completely folded. They promised not to fight the takeover. In exchange, the CEO got to keep his job and got a huge pay bump. And Lasco made a few cosmetic promises, like not taking over the whole board right away. But Lasco got everything that actually mattered. Management couldn't stop them, and critically, they got permission to pull out that $125 million in surplus cash. The fight was over before it even really started.
With management standing on the sidelines, the public tender offer was basically a done deal. Lisco offered a package of its own stock and warrants that was worth over $75 for each share of Reliance, which was only trading at about $66.50. I mean, for shareholders, it was a no-brainer. They tendered their stock in droves. By September, it was what they called a rip-roaring success. Lisco had locked up over 95% of the company, which meant they could use that all-important pooling of interests accounting. But wait. The victory created this brand new massive problem. Liesco was now officially on the hook to pay $57.5 million in cash for that 14% block of stock they'd tied up back in July. So, how on earth could a little company that started with a net worth of only $16 million come up with that kind of cash?
Now, this created a really interesting dilemma. You see, Lisco actually had the cash. They just raised a bunch of money, but using their own money was the absolute last thing they wanted to do. For one, it would totally kill the full pooling accounting they'd worked so hard to get. And two, they wanted to use that cash to keep growing their business, not to buy back their own stock. So they needed another way, a more creative way.
And their solution was just wow. It was an incredible piece of financial engineering called the Exchange and Purchase Agreement, or ENP. It was a three-party masterpiece. So here's how it worked. First, the sellers, those two family groups, would exchange their old Reliance stock for new Lisco securities. Then a brand new third party, a group of big-shot institutional investors like Chase Bank and Yale University, would immediately buy those Lisco securities from the sellers for the full $57.5 million in cash. And Lisco's role in all this? They just acted as the guarantor, making the whole deal completely risk-free for those investors.
What Lasco did, essentially, was offer these big institutions a free lunch. I mean, just look at this chart. The typical bank interest rate at the time was about 7.5%. Lasco guaranteed these investors a minimum return of 15.6%, more than double in just 1 year. And to make it even sweeter, most of it would be taxed as capital gains at a lower rate. And that was just the floor. If Lasco's stock kept flying high, their potential return could be over 55%. It was a no-risk, high-reward deal they just couldn't say no to.
You know, this whole complex structure is basically a fancy version of something called a put-call agreement. The put option meant the institutional investors could force Liasco to buy the securities back from them at the end of the year for all their money back, plus that guaranteed 15.6% profit. The call option meant Liasco could force the investors to sell their shares into a public offering as long as the investors got their guaranteed cut. It was a perfectly designed machine to take all the risk away from the people putting up the cash.
So the plan was perfect. Liasco would set up a public stock offering for the investors' shares. The investors would walk away with a huge, risk-free profit. Liasco would make a profit too, all while getting Reliance for nothing. And the general public, who were clamoring for Liasco's hot stock, would end up footing the entire bill. It was flawless. But, as so often happens in these stories, hubris and a changing market are about to enter the picture.
Feeling invincible after the Reliance deal, just a few months later, Liasco made this disastrously overconfident attempt to take over Chemical Bank, one of the biggest banks in the country. The old money establishment was absolutely furious. Wall Street turned on them overnight. The market for their kind of stock went south, and suddenly, a public offering was impossible. The clock on their E&P deal ran out, and in October 1970, Liasco was forced to make good on its guarantee, paying out over $72 million in cash that it desperately needed for other things.
And this brings us to the final, incredible, unbelievable irony of this whole saga. The very deal that almost broke Liasco by forcing this huge cash payment ended up being the one thing that saved it. As the recession of the 1970s hit, all of Liasco's other high-flying, go-go businesses turned into total disasters that just burned through cash. The only thing that kept the entire company from going bankrupt was the steady, reliable, profitable insurance business of its new subsidiary Reliance.
So what can we take away from all this? Well, first, it shows that finding a doable deal, a deal with a structural weakness you can exploit, is often way more important than just finding a cheap stock. Second, this is just a masterclass in how creative financing can completely bend reality and make an impossible acquisition possible. And finally, it proves that the key ingredient for these amazing free lunch deals isn't just financial genius, it's a wildly optimistic stock market that believes someone else will always be willing to pay more tomorrow. In the end, this quote just perfectly captures the whole paradox of Saul Steinberg and his team at Liasco. I mean, the same people who pulled off one of the most brilliant takeovers of all time immediately followed it up with an act of just stunning arrogance and stupidity. It's a powerful reminder that being a genius in one area doesn't always mean you're a genius in another.
And that leaves us with one last thing to think about. This whole story really forces you to ask, is a brilliant deal maker the same thing as a brilliant manager? It just highlights that razor-thin line between the kind of boldness that leads to a historic breakthrough and the kind of recklessness that leads to a complete catastrophe. Where does one end and the other begin?
Welcome to The Explainer. Today, forget what you think you know about picking stocks in the open market. We're going to peel back the curtain on how some of the biggest fortunes on Wall Street are really made. We're diving deep into a masterclass in financial engineering from 1968, based on the chapter, The Use of Creative Finance to Benefit Controlling Stockholders. Now, it's a story about a beer company, sure, but it's really about the hidden machinery of money.
Okay, let's just pause on this for a second, because this one idea, it's the key to this entire explainer. What this is saying is that the real home runs on Wall Street usually don't come from being a genius who finds the next big stock. No, they come from getting a seat at a private table, buying into a company at a massive discount, long before the general public is ever invited to the party.
And this lays it out perfectly, right? On one side, you have the classic story. You do your homework, you buy a great company like Xerox back in the day, and you hope it grows. That's brilliant analysis. On the other side, you have the insider's game, being part of the deal for Schaefer Brewing in '68. You get in for pennies on the dollar, and then you help take it public for fortune. Today, we're taking a hard look at that second path. And the Schaefer deal is, honestly, the perfect case study. It is so clever, so complex, and it has pretty much every ingredient you need to understand how these transactions work. It shows you how financial wizardry can completely reshape a company and, in the process, create an incredible amount of wealth for a very select group of people.
So here's how we're going to break this all down. First, we'll set the stage, then meet the players and figure out what they were after. Then we'll get into the nitty-gritty of the plan itself, see how they sold it to the public, and finally, we'll tally up the score and see who walked away with what.
All right, so first up, to really get this, you have to know who was in the game and what prize they were all trying to win, because every single move in this financial dance was driven by a very specific goal. You know, it was really like a four-way dance. First, you had the Schaefer family. They owned this really successful, cash-rich, but private brewing company. Then you had the promoters, the architects of the whole thing, an investment firm called R.W. Pressbridge. Of course, you had the big money, the lenders, giant insurance companies providing the fuel. And last but not least, you had the public, the everyday investors who, as you'll see, were the grand finale.
Now, this is the whole reason the deal happened in the first place. The Schaefer family had what you might call a rich person's problem. Their company was worth a ton, but their wealth was trapped inside it. So their big question was, how do we get our hands on all that cash? We're talking $86 million in 1968 money, without getting crushed by taxes. And, the real kicker, without losing control of the family business. This entire elaborate deal was the answer to that one question.
Okay, now for the fun part. Let's get into the mechanics of this thing. This is where you can really see the financial engineering at work, piece by piece.
And what's wild is how fast it all happened. Look at this timeline. We're talking less than 6 months from start to finish. In June, they literally invent a new company out of thin air. By November, that same company is having a massive IPO on Wall Street. Every single step was timed and executed just perfectly. And if you boil it all down, the complexity simplifies into this beautiful 4-step machine. Step 1, you create a brand new empty shell company. Step 2, you let all your insider friends buy stock in that shell for next to nothing. Step 3, you have that empty shell borrow a boatload of money. And step 4, you use all that borrowed money, plus the money you're about to raise from the public, to buy the actual profitable brewing company. It's an engine for creating wealth.
And get this, check out the actual prices these insiders paid. Before anyone in the public had even heard of this new corporation, the deal architects at Presspritch were buying shares for 42 cents apiece. The family got in for $1. Even the big lenders got a sweetheart deal at $1 a share just for providing the loans. Seriously, burn these numbers into your brain.
And this table just brilliantly illustrates the point. Where did the $122 million to buy the company come from? Well, about $36 million from the public through the IPO, a whopping $65 million from the big lenders. And look at the very bottom line. The actual cash put in from those insider stock sales, a little over $200,000. It was the definition of using other people's money. So, with all the backstage maneuvering complete and all the financing lined up, it was time to take this show to Broadway. It was time to sell it to the public. And boy, was the IPO a hit. It was 1968, and the market was absolutely ravenous for new companies. And even though the prospectus, the official document, basically said, hey, warning, this company is now loaded with debt, nobody seemed to care. The stock was an immediate success.
Okay, remember those numbers I told you to burn into your brain? Here's the first one again. 42 cents a share. That is what the deal's architects paid just 5 months before it went public. Next up, $1 per share. This was the price for the family, the executives, and the big lenders. They bought their shares just 2 months before the IPO. And then there's this number, $26. This is the price the public eagerly lined up to pay for the exact same stock on day one. The difference between what the insiders paid and what the public paid, it's just staggering. So why? Why did the public buy in at such a high price? Well, the source makes this incredible point. People weren't really buying the underlying value of the company anymore. They were buying the sizzle, not the steak. They were buying the excitement of a hot new issue, the momentum, the story, and the underwriters priced it perfectly to get that pop on the first day. All right, the dust has settled, the IPO money is in the bank, so who really won? Let's follow the money and look at the final score for each of our players.
For the Schaefer family, it was a grand slam. They solved their dilemma completely. They walked away with $86 million in cash, they got notes that paid them a steady income, and, this is the amazing part, they still effectively controlled the company they had just sold. A total, complete win. Now, what's so fascinating here is that it wasn't a zero-sum game. The promoters were looking at massive gains on their 42-cent stock. The lenders got safe loans with great interest, plus a sweet equity kicker. And hey, even the public investors who bought on day one got what they wanted, a quick flip as the stock jumped from 26 to 31 bucks right away. But, and this is a huge but, look at what happened to the company itself in the process. It was fundamentally transformed. The old private Schaefer was a rock-solid, debt-free business focused on the long haul. The new public Schaefer was a highly leveraged company, saddled with debt, and now completely obsessed with one thing, hitting its quarterly numbers to keep the stock market happy. So I think the crucial takeaway here is that these deals aren't about one person winning and someone else losing. A well-structured deal is like a complex machine designed to create different types of value for everyone involved. The family gets cash and control, the promoters get a huge capital gain, the lenders get safe income, and the public? They get a shot at a quick trading profit. And that's really the question we're left with, isn't it? Was this just a brilliant win-win transaction where everybody walked away happy? Or does a deal like this reveal something deeper about the financial system, a system fundamentally designed to give the biggest rewards to the people who get to write the rules before the game even begins?